I'm Craig. I'm the Executive Director of the Global Interdependence Center, GIC. We are happily headquartered here at the Federal Reserve Building. Today our program is Gearing for the Future of Risk Management, which we are doing in conjunction with our partner, the Financial Risk Institute. For those of you who don't know GIC, we are a nonprofit organization founded in Philadelphia about 40 years ago. We do programs on macroeconomic issues, trade, monetary policy, in Philadelphia, in New York, DC, and globally. So today our program again is on risk management. I would like to introduce our moderator for the first panel, who's Ralph Gerard, who is the Financial Markets Lab Coordinator for the Rutgers School of Business, Camden. And one other cautionary note, I've been told there's hot mics throughout here so we can pick up everything everybody is saying. So just keep that in mind as you're whispering amongst yourselves. So thanks, Ralph.
Good morning. My name is Ralph Giroux. I'm a proud member of the Global Interdependence Center of the Financial Risk Institute. I'm the Financial Markets Lab Coordinator at Rutgers University, and I wanted to welcome you all this morning, and I wanted to thank you very much for your attendance and your participation here this morning. So first, we can be just as basic as we start the program when we talk about gearing for the future in risk management. We'll be talking a lot about finance this morning. So if we want to tear apart the title from the very beginning, okay, we're talking about gearing for the future. Okay, first, the future's in this room. I'd like to thank the students from several colleges, including Rutgers University, other universities I've been affiliated with, for being here. All right, I tell my students wherever I've taught, I said, please do me a favor and learn from us, and please learn not to commit some of the sins of our generation and the generation before ours that almost caused the Second Great Depression. Not that there aren't a lot of parties to the problems that we're trying to address this morning. I mean, if you just think back to the official end of the recession in 2009, we're in 2014 and we're still talking about recovery. Okay, we're not talking about escape velocity here, okay, which we would all like to achieve and achieve in the right way. All right, we'll talk about risk. All right, we'll talk about that four-letter word here this morning and for the balance of the program. Don't worry, it's the only one I'll refer to. Through a 33-year career in finance, when I was first raised in the business, the traditional view of the financial markets were having a front office and a back office. Front office comprised of portfolio managers, a role that I filled a couple of times, of trading, a role that I filled for many years, of sales, the people that supposedly managed the money, right, gross sales and profits and which have you. And then there was a back office, all right, just the record keepers. So the people would say, okay, let's just make sure this trade isn't screwed up, or let's just make sure that our loan covenants are covered. 2008 happens, and now we have the middle office. We have the four-letter word, risk. All right, so now there's a whole area in finance, not that there hadn't existed before, but it has certainly come to the forefront that now we have people that keep score on risk and try to work with measuring what amount of risk do we have in what particular areas of organizations, okay? Whether it's in the public sector or in the private sector. And the last part of the title, management, right? How are we going to do this? Okay? We have a host of professionals here from around the country and really literally from around the world that have graced us with their presence to come here and speak about a lot of different issues. All right, just from the standpoint of the program, before we move into the first panel, just to give you an idea of the orientation for our program today, I will be moderating the first panel where you're titled Macroeconomy, Monetary Policy in the Fed, and Municipal Pension Challenges. We'll talk more about municipal challenges outside of just pensions. All right, that's what I call the so-called public sector view of things as opposed to the private sector. All right, so I'll introduce my panelists shortly, and we'll get into the program. And you have to think about the role of government on the federal level and on lower levels having to do things of an unprecedented nature. All right, and compensating for things that the private sector was either too afraid to do or was not able to do. All right, the other three panels today, panel number 2, risk on the street, operation and regulation of investment vehicles. All right, we have a couple of gentlemen from Stradley Ronan, and then we have a gentleman from Promontory Financial that will be addressing regulation, the current investment vehicles that we deal with, some things that may be coming down the road, and looking, how should we look at this particular area of finance? We take our break, and then panel number 3 is correctly titled, okay? So for those of us who are, let's say, older in the room, you know, the old saying was making mountains out of a molehill. We are doing the reverse this morning, okay? And we are going to try and make molehills out of mountains. So we talk about it from the standpoint of being very granular and working with data. You'll hear a lot about big data in panel number 3 today, and I have some great experts on that subject. Maybe looking at ways, looking at things, at variables that we had never looked at before, looking at them in a different light to try and come up with some answers in terms of gearing for the future in financial risk management. And then, you know, the age-old situation in terms of panel 4, balancing regulatory trends and profitability. You can make as much money as possible. Are you doing it legally? Right? You have to come to terms with the legal costs of what we've incurred. All right, after the financial crisis. All right, so that's the way we've set up things thematically. I can tell you that we've got quite, you know, a great assembly of people here. Please share your wealth, share your contacts, share your ideas. All right, this is not a spectator sport. All right, I'll let the moderators take care of how the flow of information will be presented. Please do not be afraid to ask questions, to tap the expertise of this panel and of this great program. And I can't thank the GIC enough, the Federal Reserve Bank of Philadelphia for being a gracious host, my people from DC, the Financial Risk Institute, for bringing up our army of people from DC, so we can get right to work at this point. So then I'll ask my 2 panelists to come up, and I'll have them introduce themselves, and we'll get right into the program. Well, I want to thank you all for being here. Our first panelist this morning will be Luke Tilley from the Federal Reserve Bank of Philadelphia. Thank you, Luke.
Good morning. Thank you. Thank you all for being here. And welcome to the Federal Reserve. Of course, we're in my building, which means I only had to come from the other side of the 3rd floor here. Very convenient. So I'm going to talk a little bit, as Ralph said, about the macroeconomy and really how that's affecting monetary policy. And as you are probably aware, there's an FOMC meeting just this week. And so I'll go over some of the details of that, and then also a little bit of the outlook going forward. I think that there are some issues here for risk management, particularly for our supervisory group, always watching interest rate risk and several other points. And really that comes down to a lot of uncertainty about how the economy is going to evolve and then how interest rates are going to evolve. So I'll talk about that a bit. Before I do that, I'm just going to point out there's a disclaimer. It's in small lettering at the bottom there, but it's incredibly important. The views expressed today are my own, not necessarily anybody else here at the bank or anybody else in the Federal Reserve System. That's important for 2 reasons. One, because there are plenty of other people within the system who have different views. And the second is because apparently there are hot mics listening to everything that I say. All right, so a quick overview of the macroeconomy. This is showing GDP growth, but broken down into the individual contributions from the four major line items: government, net exports, investment, and of course the consumer. So a lot of focus recently. I imagine you all are familiar with the sharp slowdown in economic activity in the first quarter of this year. Oh, so these are contributions. So if you sum up all of these here, you would get the overall growth numbers for GDP in quarterly terms. So the first quarter of this year, as you're likely aware, we had such a severe winter with the storms that it really had a drag on GDP, and we end up with negative 2.1% growth in the first quarter. Now, at the time and throughout, I think most economists agreed that the impacts were because of the winter, not because we had a real deceleration in growth or momentum. As you can see here, investment dropped off sharply. That was in all the components of investment: residential investment, business investment, and also inventories. Net exports fell off fairly sharply because of both on the export and the import side, trouble moving goods around. Government, not that much change. And then consumers, not declining, but a sharp deceleration for consumer activity and consumer purchases. Some durable goods, a big slowdown in durable goods, autos and other things, and then also healthcare spending. As you are probably aware, also the second quarter we do get the strong bounce back. Consumers bouncing back quite a bit, whether it be retail sales or some of that other expenditure. Really, a lot of the strength there in investment, and most of that in inventory investment. The snapback in inventories was fairly strong, as was residential and building. So we have still some confirmation that the economy is growing, and that just gives us some context for the decisions that the FOMC has been making. Now, the labor market getting a lot of attention, of course, is our best measure of how the economy is doing, in my opinion, and how many jobs are being added. The most recent number from just a couple weeks ago was 142,000 jobs in August of this year. It caused a lot of hand-wringing and angst, and especially for people who focus on one number. Is this a slowdown? Is this a real problem? Do we have some softness in the labor market? President Plosser tends to take a longer view of things, so do I, because I work here. It's a good idea. But I'm just going to point out some things in taking that longer view. Previous to that release, the 142,000 jobs, the previous 6 months had been greater than 200,000 jobs. If we had had a 7th month in a row of greater than 200,000 jobs, that would have been the first time since 1997. Before that, the previous time was 1995, and before that was 1984. It simply just does not happen that often that you have 7 consecutive months of plus 200,000 jobs added, even in strong economies. So it doesn't happen that often. Obviously, there's some frictions in hiring and that sort of thing. Taking a longer view of just how we've been doing this year in terms of job creation, take a look at the black lines here. Those are showing the year-to-date averages for the year. It's 1.7 million jobs added so far this year. Works out to a monthly average of 215,000. Comparing that to January through August of the previous years, this year is 10% higher than 2013. This year is 20% higher than 2012 and 30% higher than 2011. So we clearly do have this upward momentum and the strength in job creation, again, giving some context to the FOMC's decisions. Now, there are plenty of caveats in terms of the strength of the labor market, most often discussed in the context of the unemployment rate. So the most watched official unemployment rate, U3 measure, peaked at 10% just after the recession and has since come back down to 6.1. Now, this is getting very close to the range of assessments that we'll see from the FOMC of being a normal unemployment rate. The assessments of what is a normal unemployment rate are between 5 and 6%. So we're just right at the top of that range. But if you are paying attention to a lot of the discussion, especially from Chair Yellen, it's the underlying details of the labor market that are indicating that it's not as strong as 6.1% might have been in the past. In particular, within this 6.1%, there are a lot of people who have been unemployed or long-term unemployed, more than 6 months, much higher share than we've had in the past. She discussed in her Jackson Hole speech the polarization of jobs, a lot of the jobs that are being created at the very high end or the very low end that has implications for wage growth, and numerous other factors, including the decline in labor force participation, which is partly structural, partly cyclical with people dropping out of the labor force, but nobody really knows just how much of it is structural versus cyclical. And that brings me to the higher measure of unemployment, U6, which includes the underemployed, people who are getting part-time and would like more hours, and also discouraged workers, people who've stopped looking because they're so discouraged. Now, that measure of employment is obviously higher, but it's also improved dramatically too. It peaked at 17.3 or 17.4% after the recession, and it's come down since as well to 12%. So still a lot of discouraged workers and underemployed workers, but we should point out that over the course of time, it's always higher than U3, of course. Not quite double, but just about double. So some two-handed economist stuff there. On one hand, it is coming down. On the other hand, we still have some issues to deal with the labor market. Plays into the context of the statement yesterday and recent statements from the FOMC. And then lastly, inflation. I'm showing year-over-year changes in the overall measure of inflation and then also core inflation, which removes food and energy prices. But really, that distinction has not been very important over the past couple of years. They're both running just between 1.5% and 2% recently. A little bit of an acceleration in just the very beginning part of this year, the first few months of this year, but the last couple of months have been fairly soft. So that brings me to the FOMC and the forecast that were released this week. So this is showing their forecast for real GDP growth. The width, the entire width is showing the full range of forecasts from the 18 participants. And then the darker blue area is the central tendency, so throwing out the three most optimistic and the three most pessimistic. Their forecasts from this week were not greatly changed from the June meeting. They still are forecast. Oh, and I'm sorry, the farthest to the right here is their longer run assessment. So this is their assessment of what is essentially normal GDP growth. So especially if you focus on the darker blue, the central tendency, the FOMC generally looking for a little bit stronger than that longer run rate of growth. And that should help to keep improving the economy and keep adding jobs. But you can tell it's not robustly stronger than that longer run estimate. So their forecast for the unemployment rate, this came down a little bit relative to the June forecast, as the unemployment rate has improved quicker than they had anticipated, as it has over the past several years. And you can see here what I had already mentioned. Their assessment of the normal long-run rate of unemployment is between 5 and 6%. They have us coming down into that range almost immediately by the end of 2014 and then into 15, 16, and 17, even below it. So that is what brings in that important discussion of, well, this is U3 measure and that's what they're forecasting, but those underlying details about the long-term unemployment, about polarization, about wage growth really goes to the heart of their assessment, their stated assessment about still some underutilization of the labor market. And then their forecast for inflation, this was raised a little bit relative to June, but as you can see, staying below except for one or maybe two participants having it come up a little bit, but generally, especially the central tendency, remaining below that 2% in that 2% growth in prices. So those are their forecasts, and bringing some context to their decisions about the asset purchase program and then about the communication for the federal funds rate. So the policy action from this week, of course, is to continue the tapering of the asset purchase program. So this started at $85 billion a month in September of 2012. And starting in December of last year, at each meeting, they've successively dropped it $10 billion each month, now down to $15 billion per month until the next meeting, where most assessments are, and Chair Yellen has said this, that they believe that they will be done, unless something in the economy changes dramatically, they'll be done with the asset purchases in October, this fall. And really, because as that is winding down, brings the most attention, of course, to the federal funds rate. Now, no action was taken. The target rate stays at 0 to 25 basis points, but a lot of discussion about the language, of course, and the guidance of where and when they think that this is going to change. They did not change the language that they have had for several meetings now. they expect the target range for the federal funds rate to remain appropriate, this low rate to remain appropriate for a considerable time after the asset purchase program ends. So there was a lot of speculation over whether that language would change or be removed, and indeed it stayed in. There are a lot of questions about what does a considerable time mean, and Chair Yellen emphasized strongly that it depends on the data. It depends heavily on the data. Nonetheless, that did not stop two of the participants, our own president, President Foster, and then also President Fisher, from dissenting based on this language. They were not dissenting on the no change in the federal funds rate nor on the asset purchase decision, but on this language that they believe conveys that rates will stay longer than necessarily they think appropriate. In terms of more information about the federal funds rate and when is the so-called liftoff going to occur. This is the 18 participants being asked, what do you think the appropriate federal funds rate is at the end of each of the given years, 2014, 15, and 16, and now 2017 was added, and then their assessment of the longer run estimate. So at the end of 2014, almost all but one believe that the funds rate should remain at this the zero bound, while one participant believes it should have moved up. Most expectations, and indeed the communication from the FOMC, is that it will probably move up sometime in 2015, and indeed most of those participants believe that it should, although there are two participants there. You can see by the end of 2015 they believe it still should be at the lower bound. By 2016 it has moved up, in 2017 even more so. Clearly a wide range of opinions, so a lot of people in the financial press and analysts will focus on the median of these projections of appropriate policy. So what has happened with the median? This has gotten steeper over the past couple of meetings, indeed this week's meeting. So it's getting a little bit steeper as the FOMC says, we think that the considerable time language is still appropriate. We're still going to wait a considerable amount of time. We think it's appropriate. But as they've changed their forecast and they see the unemployment rate coming down faster and GDP growth picking up, and job growth fairly strong, this has gotten steeper. Now, obviously, that has implications for financial markets. You'll hear a lot of people say that the Fed can raise interest rates in two ways, either because they are moving up with the economy as it goes along, or if the Fed waits too long, then it's chasing the rates up, and the economy really starts moving them up first. So this steepening of this estimate is really starting to get a lot of attention.
I have one quick question on that.
Sure.
Are you allowed to speculate at all on which one of those dots is Janet Yellen? A little more important.
I'm allowed to speculate on it all I want, yeah. Actually, I haven't heard anybody ask her that, but there was a interesting gamesmanship between a reporter and Chairman Bernanke during one of his press conferences, and it was like in more words than that, but essentially said, which dot are you, Mr. Chairman? We really want to know that. I haven't seen somebody try to pin her down. I do not have an estimate of who it is at either of the extremes, but I don't know where she is. She doesn't give point estimates for sure. Yes?
So I was just glancing at the Wall Street Journal this morning, and there was a discussion of flattening of the yield curve.
Okay.
We're talking about it as a warning signal, but there's also been previous talk about increased demand for longer-term U.S. Treasuries because of the falling rates and the suppressed rates in Europe.
Okay.
And so I'm just wondering if the U.S. takes off ahead of Europe, is the Fed funds rate going to be able to affect the level of the rest of the yield curve, or is it going to be end up sort of out of range of that rate? Since if there's a big bubble in demand for treasuries from overseas.
Oh, here's where I get to do my two-handed economist thing quite a bit, right? Or maybe even three-handed economist. Yes, and no. So the components, obviously, of the long-term rates are what influences them. It's influenced by demand for other securities, such as securities in Europe or equities or anything like that. But then also the expectation of short-term rates, right? Any long-term loan could be financed by a series of short-term loans. So the federal funds rate is always going to play into the long-term rates in the sense that the expectation of the path and whatever the FOMC is saying plays into it. But the relative influence of those things could certainly change. So actually, you ask a good question as I move into this slide, which is going to show the yield curve over the past couple of years. So I'm going to use this to help answer your question a little bit. And that's as the Fed has been conducting all of these asset purchase programs and what we've seen happen with the yield curve. Now this is, as you point out, in the context of weakening in Europe and then a strengthening in Europe and now a weakening again. Now my most recent data, I'm doing a quarterly average to 2014. And it's amazing the actions that the Fed takes. There is so much influence, there is so much expectation on the Fed on when you're going to raise rates. But the Fed only has some influence. They've said consistently that we're doing this asset purchase program to put downward pressure on long-term rates. Not necessarily, and certainly not that they can control them explicitly. So in the third quarter of 2010 and then 2011, we moved so low in 2012. Now the third quarter of 2012 is where the QE3 starts. So this is where we started buying $85 billion per month of securities. So if the Fed is exerting downward pressure on rates from this point, buying $85 billion a month, of course you would expect it to move down, and indeed it does not because of all the things that you're pointing out. There are so many other influences on those long-term rates.
Yeah, and I would think that the theory is that like a 10-year note is 5 series of 2-year notes. So if you keep the 2-year note yields compressed, the back-end rates can only go so far. But there are other factors that drive back-end rates, and I think one of the reasons why they've stayed under pressure is if you look at global long-term rates, because the U.S. economy is not really immune from what's going on in the rest of the world, global rates will tell you that there are major concerns about future growth and inflation.
Mm-hmm.
So long-end rates are influenced by geopolitical events and international. And then there's one other factor, I believe, that there's a shortage of real long-term, long-dated, high-quality collateral in the back end. And recently there was, last year, starting in January of this year, the Pension Benefit Guaranty Corporation sort of changed the rules, increasing the amount of premium. In other words, they did it to make it more expensive for private pension funds to become underfunded. So they have bigger penalties. So as they become more funded, there's an incentive to move away from their equity allocations and match assets to liability. And what does that mean? It means far more demand for long-dated, high-quality collateral to match those liabilities.
Right, more demand for the securities that we've been tapering the purchases of, but that we still hold, obviously a lot of them. So I agree. And inflation expectations, of course, another important driver for the long-term rates and the relative rates. So I agree. Only one more line to pop up here. This one really just makes it messy, but where do we stand now? 2014 Q2 back up there. So just, I think, a nice picture of exactly what you're saying, so many influences on the long-term rates. And then just one last chart in terms of, one last chart in terms of current expectations for long-term rates is definitely that they will be moving up over time. We know that they can't stay this low forever. These are not Federal Reserve forecasts. The Federal Reserve does not produce forecasts. The SPF is the survey of professional forecasters. That information is gathered by the Federal Reserve Bank of Philadelphia and published, but it's private market forecasters. And then we also have the Blue Chip Financial Forecast and CBO. Different starting points in terms of the vintage of these, but just a nice picture of the overall expectation that these rates are going to move up, and that causes issues and concerns about housing market, about economic growth, and of course managing risk. So I will yield to my fellow panel member here, Tom. Happy to answer questions during the moderated portion. Thank you. Oh, there's a mouse up.
All right. I'm Tom Kozlik. I'm a municipal credit analyst at Janney Montgomery Scott. It's a broker-dealer here in Philadelphia. By way of my background, I was a public finance banker for almost 10 years with Payne Webber / UBS and then Bear Stearns. I focused on state housing finance agencies mostly, but also did some general markets work. In 2008, after Bear fell, I came down to Janney as a banker actually, but then transitioned to become a credit analyst. That's what I do now. So what does a municipal credit analyst do? I basically help retail and institutional investors figure out what's happening with the credit trends in the market. And it's been interesting as I transitioned from being a banker and then to the role of credit analyst. The perspectives in the market are interesting and different. Perspectives being from the rating agencies, from investors, from the observers, or even the issuers. And I think one of the things that I'm trying to do is I'm trying to bring new thinking to the trends that are going on, especially now, kind of post 2008, 2009, because there are a lot of interesting trends that you'll see that not a lot of folks are talking about. So let's jump into that. The first thing is that, and let me step back for 1 second. The theme of this talk is on municipal challenges, but you can't go to the challenges without acknowledging the fact that municipal credit is really high. And that's what this chart shows. It shows that this is the rating distribution for Moody's Public Finance ratings. And the majority of them you can see are AA and A. That's a large percentage of them are in the AA category. So, if you come away from one thing that I say today, it is that municipal credit quality right now is high. It's high compared to, this is a distribution laid on top of where corporate ratings are. Even if you compare it to corporate ratings, municipal ratings and credit quality looks even higher. The problem is that there's some confusion. There's some confusion about the credit conditions. There's confusion about what's happening. And I think one of the reasons for that is because leading up to 2007, 2008, kind of like in the housing market where investors or home buyers always thought that home prices were going to rise, I think that oftentimes people just think that credit quality in the municipal market is always going to be solid, that a GO is always going to be a great investment, that an essential services bond, something for water or electric, that it's always going to get paid because people are always going to pay their bills. That's not necessarily the case. And there are some, there are a lot of accounts in the press right now about Detroit, Puerto Rico, Harrisburg. I refer to those right now as outliers because there are extenuating circumstances that revolve around those. I'm going to be talking about some other specific trends that are even a little more troubling. But there's been a lot of attention to those outliers. I was talking, it was interesting, I have some folks who I talk to on the retail or institutional side who they just think they need to stay away from munis because of these outliers that they hear about. There was a retail account, a $15 million account that I was talking to, and the children of the mother of this account had been saying, we're seeing all these things in the paper about all the negative press about Detroit, all the pension woes. We don't want to buy municipal bonds at all. And I'm telling the financial advisor, I'm telling the account, there are some credit conditions, there are some credit issues to look out for, but you don't stay away from the market completely. On the other hand, there are folks where the rating agencies are guilty of this in some ways because they're trying to get issuers to continue to get their ratings. And then even from the analyst perspective, there are a lot of analysts who are a little more optimistic or positive than I think than what they probably should be. So what do credit trends actually look like? So blue is the Moody's rating distribution was in 2011, and the red is where we are right now in 2014. So credit quality is still high, but it's fallen over the last couple of years. And one of the things that a lot of people ask me about is back in the end of 2010, Meredith Whitney made this famous call in a 60 Minutes interview, and she said that she was calling for 50 to 100 large-scale municipal defaults that are going to amount to hundreds of billions of dollars. And aside from the fact that just mathematically couldn't happen, because for that to happen, there's maybe local governments have maybe on average $20–30 million of debt outstanding. For that to happen, every large city would have had to have defaulted on their debt. So it just wasn't going to happen. That when she went on television and talked about it and said that told me and a lot of others in the analyst community that she just didn't have a firm grasp on the municipal market. But now in 2014, it's important to note that it hasn't happened, and it's not, and even though we're seeing things like the press accounts of Detroit and press accounts of Puerto Rico and Harrisburg, defaults are still pretty low. These and defaults are even lower where the defaults are even lower where we when we look at the local government sector. The local government sector is in orange here at the bottom. And these are bankruptcies. Bankruptcies have also been pretty low, and bankruptcies for local governments are even lower. Detroit did happen, but for the most part, local governments aren't filing for bankruptcy. So, I don't expect that there's going to be any kind of municipal market meltdown in the way that Meredith Whitney expected. But I do think that investors need to kind of refocus. Investors and observers need to refocus. It's interesting. I think that the viewpoints on municipal credit have evolved kind of pre-2008, 2009. A lot of the deals were insured, and in some ways, folks didn't really pay that much attention to underlying ratings. And municipal bonds became a pretty commoditized product. Spreads really tightened. Then kind of 2008, 2009 occurred. Then in 2010, there were a lot of, for example, reporters who were looking to figure out what the next subprime loan market was going to be that was going to bring down the financial system. There were a lot of reporters who were looking at municipals, looking at the amount of pension debt outstanding, and looking at what they were calling is the kind of irresponsible ways that state and local governments were spending money. Then Meredith Whitney happened, and it's interesting because then after Meredith Whitney, municipal analysts, the municipal community they made, including me, just an overly passionate defense of credit quality. I went on TV many, many times and said the municipal market is very resilient. States and local governments, they've been through tough times. They know how to cut, and I didn't think that, and I and most didn't think that anything close to what Meredith Whitney was talking about was going to happen. But one of the things that is happening is that, and I just published a piece on this a couple of days ago, I am seeing cracks in the state government sector. And there has been an unprecedented level of credit deterioration of the local government. There are local governments that have been downgraded, for 22 straight months, downgrades have outpaced upgrades. Let's get to the state sector first. Overall, the state sector, credit quality is pretty high, as you can see here. The thing is that state tax revenues in the first quarter of this year and the second quarter of this year, year over year, are down. Now, one of the things that this is being chalked up to is the fact that the fiscal cliff kind of pushed some revenues a little forward. So I don't think that this is necessarily saying that, first of all, the economy is going to be falling off the cliff, because no economist and no one is thinking that. But this is definitely a trend to be watching out for. Reserve levels, state reserve levels, they look pretty high. If you look at that last bar, it's almost as high as it was kind of pre-financial crisis. The problem is that over 50% of that bar are from Texas and Alaska. States like Pennsylvania and New Jersey and some of the other states that had decent reserves have little, if no, reserves right now, because they've used them up over the last couple of years in balancing their budgets. These are the ways that states over the kind of 2010, 2011, 2012, these are the strategies that states use to balance their budgets. 76% of them use spending cuts. Only a small amount used an increase in user fees or taxes. This is something that I think is now continuing to flow through. There's a real aversion to wanting to look to raise taxes and to raise user fees. This is just a list of some of the rating actions. Positive on the top. Notable upgrades were California and New York. And it's important to point out that the upgrades from California and New York, for the most part, were as a result of kind of managerial institutional governance and changes that those states put in a couple of years ago that they're finally seeing the fruits for now. In contrast, we see Pennsylvania and New Jersey, for example, and Illinois. Those are the three states who I really focus on a lot. New Jersey's been getting downgraded. They got downgraded again, I think, this past week by S&P. It's an interesting situation there in New Jersey and Illinois. And people don't understand also in Pennsylvania's fixed costs, especially their pensions, are really building. And Pennsylvania is not funding the pension plan that they should, and so it's building making it even worse for the state. And the problem is that for all these states, what happens is that state governments have the sovereign ability to cut spending or raise revenue. As I showed you, not many of them are raising revenue; they're cutting. And one of the cuts that they're making is to state aid for local governments. Local governments, for the most part, are still rated pretty high. You can see here in this distribution. But what's happening, as I mentioned, is that downgrades for ratings for local governments is drastically outpacing upgrades. And this is really, I mean, there's never been data like this. I mean, you can see those big red lines, and it's not just, 10 downgrades to 5 upgrades. I mean, it's in the hundreds. And I mean, this is very problematic. This is something that in my business, frankly, doesn't get a lot of attention. There aren't very many people who talk about this and focus on it. I focus on it a lot. What I've actually done is I've gone through and looked at the reason why the downgrades are occurring. And what I found when I went through, this is just for the second quarter, this is second quarter 2014 data. Over 50% of the local governments that were downgraded in the second quarter of this year were because they have multi-year structurally, their budgets are structurally imbalanced and have been for a number of years. Now, and so what does that mean? That means that basically recurring revenues are not paying for expenditures. That kind of a situation for local government is very, very difficult to fix. And this is not Detroit. These are not necessarily just Rust Belt type areas. One of the things I actually tweeted about this week, because my family lives in Western Michigan, there's a high school, East Grand Rapids High, in Western Michigan, just outside of Grand Rapids. Actually, you might know it because the student who went there, there's a student who went there in the late 90s, and he wrote the screenplay for the movie American Pie. It's a very good area, very high wealth levels, and it was just downgraded. It had been progressively downgraded over the last couple of years. It was just downgraded again to A1. And because it has there's a multi-year structurally, they have a multi-year structurally imbalanced budget. And much of that is because there's been lower state aid, but it's also a very wealthy area. They don't get, there are some school districts that get, 60, 70% of their revenue from state aid. I mean, this is a very wealthy area. They only receive like 10 or 20% of their revenue from state aid. So it's not just state aid. It's because they are really not managing their financial situation. This is the picture that I think best describes what it is that local governments are going through and why it is that even some of the local governments that are in higher wealth areas are getting downgraded. That the squiggly blue line is actual local government tax revenue. The yellow line is what the tax revenue trend was pre-2010. The green line is the trend post-2010. So the way that local governments usually budget is they kind of look at the last couple of years of their tax revenue, and they say, okay, we're expecting to have this amount of money kind of going forward. And so what's happening now, even though it's 2014, is that there are a lot of local governments who don't quite understand that the new reality is the green line and not the yellow line. And on top of that, there were fixed costs, including debt, and oftentimes, as one of the things that Ralph mentioned, were pensions. Pensions are fixed costs that are very, very difficult, if not impossible, to change. And pension costs are part of the thing that makes it so it's very hard to change their spending patterns. So this differentiation is one of the reasons that many of those downgrades are happening. So, what is the current status of municipal credit quality? As I showed you, credit quality as far as ratings are concerned are still pretty high at the state level and at the local level. There are some indicators to watch. You want to make sure you're watching state tax revenues to see how those trend over the next couple of quarters. But at the state level, there's some significant credit deterioration happening in Illinois, Pennsylvania, New Jersey, for example. At the local government level, Janney's official outlook for local government credit quality is cautious, and one of the reasons it is cautious is because of that imbalance that we're watching, and that imbalance is causing the downgrades to really outpace operates. So those are my prepared comments. So I think we'll take some questions.
How are you? I'm a bank examiner here at the Federal Reserve.
Yeah.
And so we go into a lot of small community banks. Some of them completely avoid municipals. Some of them have, majority of their portfolio of municipals. My question is, why is Texas so good? You see a small community bank in PA and they own a bunch of Texas municipals. What is it that they're doing down there that is such a strong bond?
Yeah, so the question is what is it that Texas is doing that's so good that makes it so the credit quality there is higher, maybe relative to Pennsylvania, where the trends are a little more positive relative to Pennsylvania. California, even though California's been upgraded recently, one of the big questions that folks ask is, well, why is it that businesses are moving from California to Texas? I don't know Texas as well as I do New Jersey, Pennsylvania, but from what I've read, I think that the tax situation in Texas makes it so it's a more attractive area for businesses, and so I think that in some ways and unemployment levels, and you look at some of the economic indicators in Texas, they're much more positive than they are in Pennsylvania and New Jersey. I'd have to imagine that if I looked at the data that shows migration into people moving from places like the Northeast and the Rust Belt, I'd probably see that there's positive numbers for people moving to Texas from throughout the country, I would guess. One of the things that I'm also thinking about too is that Texas has a really good program for school districts. They have it's the Texas Permanent School Fund, where the state has a special guarantee for school districts. So I think that's probably one of the reasons that there are probably some folks who are buying a lot of Texas school district bonds anyway.
They also have oil and fracking.
Pardon me?
Oil and fracking.
Yeah. So does Pennsylvania. Yeah, so does
No
Pennsylvania.
tax. So I was going to follow
Oh,
up.
yeah.
Well, because I've heard that from some of our
Yeah,
analysts here, we don't tax fracking really, so the way Texas does, and that gives them the additional revenue. So would you like to see Pennsylvania do that, maybe disrupt their credit quality?
Yeah, I mean, so the question is about, what if Pennsylvania started taxing really oil and gas activity is what you're getting at, I think. It's hard to say because I don't know what the potential, first of all, I don't know politically what the potential is. It looks like there's a chance that Corbett might not get reelected. If you look at the data, it's not looking good for him. What is Wolf going to do if and when he gets in office? I talked to folks. One of the things that he says is that, especially where Pennsylvania school districts are concerned, he says that he wants to start raising state aid for school districts. And Corbett hasn't reduced state aid for school districts any more than what I think anybody else really would have. I think that if there is somebody who's elected in Pennsylvania, once that person sits in that chair and starts looking at the financial situation, they might finally decide to raise revenue on the oil and gas industry, but I don't know how much that's going to end up raising. And to tell you the truth, one of the things that I always tell people to look out for as far as the local governments are concerned is that there's a lot of wear and tear that occurs as a result of that activity in those areas around kind of Pittsburgh and Scranton. And so one of the things that I worry about is what the negatives are going to be for those local governments where there are a lot, if there are kind of either school districts or other housing that's got to be built or roads that need to be repaved. I think that there are some expenses that you're looking at for those local governments where the oil and gas industry is concerned too. And so that's actually one of the things that I look out for Pennsylvania local governments.
Actually, what I wanted to do at this point was I wanted to pose a question to each of my panelists. First, that's fine. Why don't we do that for a quick second? I know we're going to try and do this, and then we ended up getting into the flow of the Q&A, which is great. First thing, I can go ahead and ask. I would say first for Luke, considering all the data that you've presented to us about the Fed's view of the economy, the Fed's view of rates, considering that this conference is about financial risk management, the Fed has had to watch a lot more than the private sector. It has to watch the public sector as well. Tom's area of expertise. So my question to you is, are there any particular aspects of municipal finance or of government actions other than what's done on the national level that the Fed is looking at in terms of viewing the future?
Well, I think that the Fed is constantly watching all areas of the economy, and municipal finance and government finance is, of course, important. About 20% of total employment is in government generally, federal, state, and local, and there's a lot more people who work state and local governments than they do for the federal government. So to the extent that municipal finance is getting in trouble, and it could translate to job cuts and performance in the economy, that becomes incredibly important for wages and for the performance of the overall economy. Here in our district, New Jersey had a lot of job cuts over the course of the recession and the aftermath, and that of course plays into overall job growth numbers and how that state is doing. So as a regular thing in the FOMC meetings, they do get a financial markets briefing at the beginning of each FOMC meeting. It's not really referred to in the statement at all, but if you ever went to the minutes of FOMC meetings, which come out about 3 weeks after, you can see that the financial market briefing occurs at the start of each FOMC meeting. And to the extent that there are stresses in municipal financial markets that are rising to the level, they would show up in that briefing, I believe.
Okay, thank you. Lets you know, for everyone in the audience, with 20% of employment coming from the government sector, even though there are some areas that have recovered smartly from 2009, there are still worries on the other end, and that leads to a question for Tom. As far as the municipal market is concerned, yes, there's a lot of data we have, and then by the same token, those of us that have followed the municipal market for years and maybe even for decades wonder about the quality of some of the data, some of the opaqueness of the municipal market. Now, we were just talking before this particular panel about oversight. The Fed has to worry about oversight. The Fed has a lot more to worry about than what its original mandate might have been. And I wanted to ask you about any particular moves or anything you're seeing in terms of the quality of data in the municipal market and any regulatory things we can look at.
Yeah, that's a really good question. I'm going to make 2 points about that. And I'm going to mention my old boss, who now works for the Treasury Department. And the second thing is I'm going to talk about, when you're talking about the quality of data, I'm going to mention S&P's local government ratings. But the first thing is my old boss from Bear Stearns was just hired by the Treasury Department at the beginning of this year, and he's now the director of their Office of State and Local Government. And what he's doing is helping monitor and helping to answer questions about what's happening in the municipal market. So I think that there is something, he is somebody, and he's somebody who I talk to on a regular basis because he's asking my opinions about what's happening. And he has been in the business, he was in the municipal business for a long time. So he has a very firm grasp of the business. And so I think that he's the perfect person to be in that role. So I think that there are things happening at the federal level, and there are probably other things that I'm not aware of. The second thing is I was going to mention when you were asking about the accuracy of the data, and that's a great question. I actually published a paper back in July, published a report back in July titled, "Are S&P's Local Government Ratings Too High?" If you noticed, all of the data that I used, all the ratings data that I used are from Moody's. And that's because, in my opinion, and most people's opinions, Moody's data, as faulted as data from the rating agencies might be, is the closest thing that we really have that's published that can show these types of trends. Now, if I was going to show you, if I was going to use the same exact data from S&P, the S&P local government, you saw all those big red line, those big red bars in the negative. S&P is, I can't even say the opposite. I mean, they hardly have any downgrades. And the reason for that is twofold. The most important reason is because they have a much more optimistic view on the credit quality of local governments. As you can probably tell, I'm a little more skeptical. I think that, like I said, I think that credit quality is high, but that there are some cracks in state and local government to be looking out for. But S&P just overall has a much more optimistic view. The second thing is that they translated that more optimistic view into new official criteria for local government ratings, and they published that back in October. And after October, local government ratings were even higher. And so, not only over the last couple of years where S&P rating is higher than at Moody's, they're even higher now. And they used to be maybe a notch once in a while, 2 notches higher than Moody's. Now they're multiple notches higher. So the trends, the trends, and you can take a look at this report. It's on the Janney website, or contact me and you can take a look. But the data from S&P, I think, is a really good example of data, especially for the local government, that isn't all that clear.
Okay, thank you, Tom. We might have time for just one more question, please, 1 or 2 more. Go right ahead.
Well, let me start by telling Mr. Tilley that I think he did a good job and maybe he deserves a promotion.
Oh, thank you.
Well,
I agree.
I'm sorry, no, that's at the end.
Your presentation started with, I think, a nice overview as to where the economy is and the progress that has been made. The forecasts I don't care about because they've been historically awful. And then you have the dot plots that say, all right, there's a wide dispersion so that, there's a lot of uncertainty as to where we're headed. But the thing that stands out to me is that Fed policy is still in crisis mode. The balance sheet is expanding through October. It's already just under $4.5 trillion. 0 interest rates have happened, have been here for 6 years now. So to me, Fed policy is still in crisis mode, and the economy has, plodded along. The unemployment rate's fallen from 10% to 6.1%. If it is, and nobody knows, if it is a little more structural than cyclical, you could argue that NAIRU's risen and that 6.1% could be full employment, and yet the Fed is still in extraordinary policy. So I guess my question is, at some point, doing more of the same and hoping for a different outcome. The Fed has very limited tools, and so you have to say that the marginal benefits of what they continue to do are decreasing, but that the risk to financial assets aggregate the size of the balance sheet the longer they stay in this policy. And I've always wondered where that tipping point will be between financial instability, and I think that the Fed has become a source of financial instability, and we may see that through the Fed's exit strategy. It's probably come into someone's home and insult them. And so I'm wondering, certainly Flossers and Fisher, have dissented. They may be worried about that. And, I'd like to, just have you comment on that balance. And
Well, there's a lot there. Let's, I'll make several points.
be careful, I don't want you to.
No, I won't get in trouble. So you make an excellent point, and especially I think saying that the Fed and monetary policy is still in crisis mode. So the assets being drawn down, the purchases being drawn down, I think points to the FOMC agreeing that the economy has improved and it's time to get towards the normalization of policy. Probably not at the rate that you believe it needs to happen, but in terms of stopping the purchases. Now that is just stopping the purchases. As you point out, that leads to a level balance sheet, especially since they continue the reinvestments. And I think, one thing that is helpful is that the FOMC is talking about the normalization of the balance sheet. They released their principles yesterday, along with the statement and the forecast, just laying out a plan and saying to financial markets, not when, but how they expect to go about the sequence of events in terms of normalization. So right now, it appears when dealing with the balance sheet that once they start raising the federal funds rate, that's when they would stop the reinvestment. So that would start a little bit of a downward movement in the total size of the balance sheet. And then they had a couple points saying, if the economy, the way I read it was, if the economy progresses faster and they need to sell securities, then they are prepared to do that, but kind of seems like they're hoping not to, because they don't want to have to flood the market with securities. It would have to be a very, very measured, calibrated process. So in terms of being in crisis mode also, I think that caused all of the angst with the reporters in asking Chair Yellen the questions yesterday. Why didn't the language of the statement change when you clearly have a steeper curve for the expected rise in the federal funds rate and the economy has improved so much? And she spent a lot of time answering that question yesterday. So I would characterize it as the statement was in more of a crisis mode than the actual data and the forecast that you're getting. And then lastly, I think you make a good point is in terms of the projections going forward. Not only are we in a mode right now with a very accommodative policy, but if you look further out, even in those projections, if you look at the median expected federal funds rate as of 2016 and 2017, it's still around 2 to 2.5%, with inflation of around 2%. So you're still talking about real rates of very close to zero. And President Plosser is one who has pointed out that that is not normal if you have normal unemployment rate and normal growth, and that is problematic. And I think that leads to the concerns of the things that I was speaking about it might be the case that rates end up having to move up faster. So I don't disagree with you on any points. I'm just sort of pointing out where the FOMC is with that.
Okay, since it's my panel and the walls have ears, and we're just a few minutes past my panel allotted time, if you believe that both Luke and Tom deserve a promotion, let's give them a round of applause, please. Okay, now Nick Karitz is the moderator of the next panel. All right, thank you.
So the next panel, as everybody gets up to take a break here, the next panel we're going to have Fabio Battaglio and Chris Zimmerman will be talking about regulation of and operation of investment vehicles, with I think an emphasis on regulation. They're going to focus on mutual funds, hedge funds, and ETFs. And I think, from my point of view, the most interesting, they're going to cover the baseline of what is the regulatory environment currently. They're going to talk about what have recent developments been, and then we're going to ask them questions about the future and make them speculate. I think, from my point of view, the most interesting point for me as a risk manager and somebody who's been involved in a lot of economic capital and Basel kinds of issues, stress testing, is the current discussions at the SEC on potentially stress testing asset managers, which is a subject of debate. We don't know how they're going to come down. So there's the stress testing of the banks that's gone on. There's DFAST for banks under 50 billion. There's CCAR that's going on for the very large banks. And then there have been non-banks that have been categorized as SIFIs. They need to comply with the SIFI, with the CCAR regs. And so there's a lot of conversations. Are asset managers systemically important financial institutions? So I think there's a lot of stuff going on in this space, and it'll be very interesting to hear what they have to say.
Okay. Everyone hear me okay? Okay, thanks, Nick. So I am Fabio Battaglia. I'm with the law firm of Stradley Ronan, based here in Philadelphia. My colleague Chris Zimmerman is here from our Washington, D.C. office. And we are both part of our investment management group, which is a group within the firm of about 50 lawyers that focuses on mutual fund clients, hedge fund clients, and ETFs. And so our background and our expertise is essentially SEC regulation of these investment vehicles. What we want to do today is to start off, as Nick mentioned, and give you basically an overview of the differences in regulation for the various types of vehicles, and kind of set the table for the second part of the discussion. So what I will do is cover hedge funds. We're going to, I apologize, Chris and I are going to do a little bit of a dance here because I'm going to do the first point, and then we'll bring him up for the second, and then I'll return. But we'll start with hedge funds, we'll go to mutual funds, and then we'll go to exchange traded funds. What we're doing essentially is we're going from the least regulated to the most in terms of the level of SEC regulation of these different vehicles. And then also, as Nick mentioned, at the end, we'll get to some recent developments related to risk. And you know, this is I think our panel here is slightly different than the others that you'll see, and that it's more, it's probably less focused on data and more focused on the current state of regulation. So a few basic points. Pooled investment vehicles, which is the focus, and there are obviously a number of other types of pooled vehicles beyond the three big ones that we're covering today, but those are the three that I think are most familiar to most people, and I think can be illustrative of the different types of regulation and the different issues that come up. So we'll focus on those three. Essentially, they're designed to deliver investment management services in an efficient way to large numbers of shareholders. Why would an asset manager use these different types of vehicles? Well, that's driven primarily by a couple of types of considerations, and we'll get into this in more detail. But essentially, the decision to use one vehicle relative to another is driven by the type of investments the vehicle will make, the type of investors that the asset manager is targeting as its sort of audience for the vehicle, and also the purpose. Meaning, is the vehicle designed for use in sort of retirement accounts? Is it intended for other purposes? So the last bit of data, and this is, I think, the end of the numbers as far as our presentation is concerned, just to give you a sense of the size of the various markets, mutual funds being by far the largest pool of assets, and you know, as we'll discuss, they are really the vehicle of choice for the retail investor. Hedge funds, much smaller in size. Exchange traded funds, smaller yet, but growing rather quickly. And we'll talk a little about the impact of exchange traded funds on the marketplace and the SEC's regulation of those funds later on. This is a very basic structure, and we'll just skip through this pretty quickly, but just to make the point that what you have with these pooled vehicles is essentially a legal entity, which is the fund, which is really just a pool of assets. It's typically structured as a corporation or a trust, and it has no employees, it has no assets generally besides the portfolio of securities that it owns, and it has to outsource all of its functions. So it will have an investment advisor, which is typically involved in setting the fund up and sponsoring it. The advisor will manage the fund's portfolio in return for a fee, and then the fund has various other service providers. These are just some examples of the different service providers that basically carry out the business of the fund. And so with that, I'll just talk about a few of the key regulatory provisions. The two that Chris and I deal with most commonly in our practice are the Investment Company Act of 1940 and the Investment Advisors Act of 1940, two sort of sister pieces of legislation that were, as you can tell, adopted in 1940 in response to a study that the SEC did that identified several abuses going on in the mutual fund market. And we'll talk a little bit about the protections that those statutes provide for investors in mutual funds and how they're designed to mitigate risk to the investors in the funds. Also, the Securities Act of 1933 and the Securities Exchange Act of 1934, another set of sort of sister pieces of legislation. The Securities Act of 1933 is generally a disclosure statute and requires registration and disclosure for securities that will be sold to the public. The Securities Exchange Act of 1934 most notably creates the SEC, and it also governs the exchange of securities in the marketplace. The investment vehicles that we're describing are subject to other rules and laws, but to a lesser extent. So, for example, the IRS is a regulator of mutual funds to some degree. The tax code applies. There are FINRA rules that apply to the sale and distribution of mutual fund securities. So there are others, but these are really the key regulatory provisions. And then under each of these statutes, you have an extensive array of SEC rules that are essentially designed to implement the statutes in various ways. So we'll start off, as I said, with the least regulated pooled investment vehicle, which is a hedge fund. And hedge funds are basically they avoid SEC regulation in several ways. Now, they are regulated to some degree because by their nature, in order to structure them to avoid the regulation, you are essentially regulating them because they need to comply with the exemptions that are available. So there are two key exemptions that apply that most hedge funds rely on. One is Section 3C1 of the Investment Company Act, the other is Section 3C7. They're a little bit different, but essentially what they're both doing is they're limiting the ability of the fund to accept money from investors who don't meet certain standards. And so 3C1 fund can only be beneficially owned by no more than 100 persons, and it has an accredited investor standard, as you see at the bottom. That basically means that the investors in the fund have to have either a certain income level, which is $200,000 a year for the prior 2 years, or $1 million in investable assets. The 3C7 fund is limited to qualified purchasers, which is a higher standard. The benefit of relying on 3C7 for your exemption is that you have no limitation on the number of investors that you can accept into the fund. However, an individual investor in a 3C7 fund to be a qualified purchaser has to have $5 million in investable assets, so a higher standard. And then at the bottom, you see the private offerings under the Security Act. That basically means that these funds offer their securities and offerings that are exempt from the registration requirements of the 1933 Act. They're privately placed securities. And so for hedge funds, as I mentioned, they are basically set up in a way that allows them to be exempt to avoid significant amounts of SEC regulation that applies to mutual funds under the 1940 Act. With that lesser amount of regulation comes greater flexibility, and that's what makes the hedge fund vehicle a vehicle of choice for certain types of investment strategies.
Fabio, can I ask you a quick question?
Sure.
So you have private offerings under the Securities Act, private placement to accredited investors. Is this the same category of investors as the Investment Company Act?
I'm sorry,
So you've got qualified purchasers and
Yes.
accredited investors.
yes.
So is accredited investors the same as 3C1?
Yes. So a 3C1 fund does not have to have a certain type of investor in order to avoid 40 Act regulation, but it is limited to accredited investors in the sense that it has to.
You have to have $200,000 a year or $1 million investable.
Exactly.
Okay, so there are two different kinds of
There are two tiers, if you will,
tiers of
of standard for the potential
different
investor.
investors. Thank you.
Yes. Okay. So as I said, there's less regulation, which essentially results in greater flexibility to implement these investment strategies that a hedge fund manager might want to use. And so a couple of examples. Hedge funds have much more flexibility in their ability to use leverage. The 1940 Act imposes limitations on leverage, which are designed to mitigate the risk to the ultimate investors. And hedge funds generally are not subject to those restrictions. Hedge funds also have lockup provisions and limited liquidity, which you cannot impose in a mutual fund structure. And so that can allow an investment manager who's maybe investing in strategies that have a longer period of time to develop or are more illiquid. You can implement those strategies in a hedge fund vehicle much more easily than you can in a mutual fund. So that's a couple of examples of the additional flexibility. Mutual fund fees are very heavily regulated, advisory fees and others. And so hedge fund fees you have much more flexibility in the hedge fund space. You're probably familiar with the classic sort of 2 and 20 hedge fund fee, which is 2% of the assets on an annual basis and 20% of the gains. Something like that is just not permitted in the 1940 Act fund. There are certain types of performance fees that a 1940 Act fund can charge, but they're very limited by the statute. So hedge funds, you can kind of charge whatever your investors will accept. An interesting point that's probably more related to some of the things we'll be talking about later on is that this idea that these hedge funds are less regulated has resulted in less visibility for the regulators. So a mutual fund, and Chris will talk about this in more detail, but a mutual fund files a semi-annual report with the SEC that's disclosed to the public. It files an annual update to its registration with the SEC, which contains financial information about strategies, information about risks. Traditionally, hedge funds, didn't make any filings with the SEC. And so there was very little visibility on the part of the regulator into what this market looked like, what types of investments hedge funds were holding. And that's changed quite a bit over the last few years. There have been changes in connection with Dodd-Frank that increased the number of hedge fund investment advisors that were required to register with the SEC. previously, if you were a private fund, if you were managing private funds or hedge funds, you could avoid avoid SEC regulation in many instances. That has changed, and now if you're an investment advisor to a private fund and you have more than $150 million in assets in that private fund, you must register with the SEC. That change alone resulted in a 50% increase in the number of investment advisors that were registered with the SEC. So you have a much greater percentage of private fund advisors that are subject to SEC registration. You'll see their information on Form ADV. Form ADV is the form that an investment advisor files with the SEC to register, and it provides information about the advisor's business. Form PF is a relatively new fund over the last couple of years that private funds actually and their advisors must file with the SEC. And this really gives the SEC much more visibility into the holdings of private funds. Form PF is filed on an aggregated basis. So what the SEC sees, and by the way, an important distinction here is when mutual fund filings generally are publicly available on the SEC's website, Form PF is only available to the regulators. So the hedge funds are not disclosing this investment information publicly, but it is disclosing it to the regulator, and it puts the SEC, as we'll discuss a little bit later, in a much better position to have a sense of where the risks lie in these products and exactly what the market looks like.
What's in Form PF?
Form PF is information about, on an aggregate basis, information about portfolios. So characteristics, turnover over the prior year, sector concentration, types of investments.
But not
level of
investment by
assets.
name.
I'm sorry?
Not investment by name.
No.
Okay.
Yeah. And so again, the purpose really being that the SEC has visibility into the market, at least on an aggregate basis, if not on a really granular basis. And then what we'll talk about a little later on is what the SEC is doing with that data, which has been a really important change to regulation and a change to the way the SEC is viewing their regulation of these vehicles. Traditionally, the rules were in place, and that was kind of the main mechanism, and the SEC would do examinations over these entities that are registered, but now you're really seeing the use of risk analytics and other things that the SEC is bringing to bear to regulate these vehicles, and those are some new developments. And this is an example of that. So with that, I will turn it over to Chris to discuss mutual funds.
Thanks, Fabio. So for basically any fund that's not excluded by Section 3C1 or 3C7 of the 1940 Act, they're considered an investment company by the 40 Act and subject to the restrictions of the 1940 Act. These include funds such as ETFs, open-end mutual funds, closed-end funds, business development companies, unit investment trusts. But by far, the largest participants within the 1940 Act marketplace are open-end funds and ETFs. So we're just going to focus the remainder of our attention on those two types of funds. In a nutshell, the 1940 Act was constructed to protect retail investors from risks, certain types of risks. It does extensively regulate the operations of these investment companies. One of the most important and distinguishing characteristics of a fund is the ability of the investors of the fund to purchase and redeem their shares at a daily net asset value on a daily basis. The mutual fund can issue, but must redeem its shares on a daily basis. It's an open-end commitment from the fund to the investor to redeem its shares. It creates daily liquidity for the fund's portfolio shareholders. Your investment is not locked up for a period of time, such as a hedge fund, where your initial investment can be locked up over an extensive amount of time, such as over a year. Funds must also issue and redeem their shares at the net asset value. Net asset value basically means the total assets of the fund minus liabilities divided by shares outstanding. It ensures that the price that you pay or receive from the fund, everyone has the same consistent price. And basically you compare this to closed-end funds and ETFs, they trade on an exchange, right? And so there could be premiums or discounts associated with those prices that are reflected in the shares that you receive on the exchange.
I had a quick question for you. So, when you talk about redemptions,
Mm-hmm.
how quickly does the mutual fund have to give you your money?
It's, there are rules on that. Basically, it's within 7 days. Certain funds have suspended redemptions. Most recently, it was the Reserve Primary Fund, the money market funds. There were some massive redemption requests that occurred during the height of the market crisis a few years back. That requires special exemptive relief from the SEC. It's a pretty serious deal, and the SEC, does not issue that order lightly.
One of the key features of a mutual fund, as Chris mentioned, is that bit of the availability of, essentially daily liquidity. And so the SEC almost never would permit a fund to suspend redemptions. And it's only in these really extraordinary circumstances that that's happened. It's much different than in the hedge fund world where you see gates on redemptions and that sort of thing. Mutual funds can't have any sort of restrictions on redemption in that way.
But what that does mean is that the SEC can prevent a run on a fund if there's not the underlying liquidity for the fund to sell out.
They can't prevent it. They can't prevent it. If the liquidity is driving prices of the underlying portfolio securities down, that's a risk of investing in the funds. It's sort of when the redemption requests, create a run on a fund, such as a money market fund, where it broke the buck, essentially.
Right.
Where it's very extraordinary circumstances, the SEC could issue that relief.
I guess the real question is, if you redeem, do you get the price prevalent on the day that you redeem, or the price prevalent when they're able to sell the underlying?
It's the day of your redemption request.
Right, so then that's how you could get a run that could blow up the asset manager, right?
Yes. Yeah, exactly. So if you have, all your shareholders redeeming at the same time, that could definitely prevent.
You lock in a price, and then it takes them 3 weeks to sell it, and it's going down the whole time, and it can blow out.
Mm-hmm.
You have no capital held against it, and you're done.
Yes. The other important thing to realize is that the daily net asset value, or the net asset value is struck once a day, and the price that you receive is the next determined net asset value. So you're not sure, if you're an investor, you're not sure, what your NAV is going to be that day.
Mm-hmm.
You can look at it, you can sort of guess where the market's going and seeing what the underlying portfolio securities are doing, but you ultimately don't know what the NAV is that day. So that's a risk that the investor has to take if they're trying to arbitrage that.
Thank you.
Yep. So another key characteristic of mutual funds is there are no limit on the types of investors as well as the qualification of investors. Shareholders can have as little as $1,000 invested in the fund, and there can be tens of thousands of shareholders in your fund as well. I'll try to get rid of this right here. So the 1940 Act requires registration of the fund, as Fabio was mentioning, with the SEC. With registration comes the regulations imposed by the 1940 Act and the rules thereafter. Under the U.S. regulatory regime, mutual funds must duly register their shares with the SEC as part of the 1933 Act, which governs the offering of sales and securities, as well as under the requirements of the 1940 Act. They accomplish this through the dual registration process on Form N1A. Form N1A is basically the prospectus document that is offered to shareholders. The prospectus document has information such as the investment objectives and strategies of the fund, whether the fund is a muni bond fund or an index fund. It also has information with respect to the investment advisor, the fees that it pays the advisor, how the fund values its shares, as well as if there's any sales charges associated with that fund. So in summary, the retail investment vehicle is the open-end mutual fund. It's the daily liquidity offered with professional money management services and diversification at much lower asset levels than a hedge fund. So the 1940 Act has various provisions built into it that protects, that is intended to protect the shareholders and the investors. I'm going to go over briefly some of the high-level points associated with the 1940 Act. The first one is restrictions to ensure liquidity. Due to the ability of shareholders to redeem its shares on a daily basis, the fund cannot invest more than 15% of its net assets in liquid securities. There are also requirements relating to diversification and concentration. Diversification limits the fund from investing a certain amount of a percentage of its assets within the securities of a single issuer. And concentration is the same concept, but it's applied on a industry-wide basis. There are also requirements designed to ensure accurate and timely disclosure. The annual registration statement update, that's the prospectus and statement of additional information, that is required to be updated on an annual basis. And all the fees and information is also required to be updated.
So Chris, as I warned you before, I wanted to understand what the definition of illiquid securities versus liquid securities is.
It's interesting. They may have said what an illiquid security is, but the SEC, most of the guidance comes down on what a liquid security is. And the SEC has stated that a liquid security is defined as any security you can redeem in an orderly market at the value that you're currently carrying.
Okay, so if the market becomes disorderly, then all bets are off.
All bets are off.
Okay.
Yeah, I mean, the way I look at it is liquidity is a vastly moving target,
Mhm.
particularly now with, all the Basel and Frank Dodd and regulations that are really hurting market liquidity across many, many markets. When I look at this, I think, wow, this reminds me of the SIVs back in '08 when you have a mismatch between, the liquidity that they're providing, meaning I can redeem today and get my money within 7 days,
Mhm.
and then the underlying securities. So it's like if things get bad, you end up with these bank run type things, and that's why you end up with potential breaking of the buck. So if they can't gate and they're required to do it, is the only option they have is to beg the SEC to kind of delay the redemption, or are there other protections?
Yeah, it's interesting. We'll quickly discuss this later, but the SEC has issued new rules on money market fund, and one of the things associated with that is if liquidity levels fall below a certain level, the board of directors of the fund can impose gates on the fund itself, and so that's another way to prevent a redemption run, essentially.
Would they ever go to a floating NAV?
That's
a
within 2
nuclear
years.
option?
Institutional money market funds they will be going to a floating NAV. All right. So the other important thing about requirements for disclosure is that there are semi-annual shareholder reports that are filed with the SEC and that are also sent to shareholders. These annual reports provide very detailed information. They provide commentary from the portfolio managers, as well as the schedule of investments, the statement of assets and liabilities as well. So unlike the hedge fund, it's very, very transparent in the mutual fund world. Okay, there are also restrictions on transactions with affiliates. One of the key elements that led to the adoption of the 1940 Act was during the 1930s, many funds were really being operated for the benefit of the advisor itself and ultimately the owners of the advisor as well, not the fund. So what happened out of the 1930s and the controversy that occurred then was the 1940 Act adopted restrictions on transactions with affiliates. That's a huge issue. It prohibits, subject to certain rules, cross transactions with other affiliated funds. It also prohibits transactions with the investment advisor and its proprietary accounts, as well as restrictions on transactions with the affiliated broker-dealers. This prevents issues such as dumping, self-dealing, and fee layering. There are also regulation of the fee structures. It's much more, the fees for mutual funds are much less than a hedge fund with the traditional 2 and 20 performance fee. The board of directors of the mutual fund basically has a responsibility to represent the shareholders' interests, and they negotiate with the investment advisor with regard to the investment advisory fees as well as the distribution-related fees, which are the 12B1 fees.
I would just point out that the use of the board of directors structure has been criticized by some, but it is a key feature of the 1940 Act, and it's a key feature of the protections that the SEC and the 40 Act itself try to afford to the investors. The fund board is in a position to, or is required to, on an annual basis, approve the management fees that the advisor is paid. And there's an elaborate process whereby the board must request information from the advisor about the advisor's profitability, fees relative to peers, and it's a process that is, you know, nothing like what happens in the hedge fund world, where you essentially just disclose your fee and an investor is free to accept it or not accept it. And you know, again, debatable whether or not it's a good model, but it's the model that's worked, you know, for mutual funds since the adoption of the 1940 Act. A few years ago, the SEC adopted an additional disclosure requirement, which I find quite interesting as disclosure requirements go, and it is that in a mutual fund shareholder report, the fund is required to disclose a description of the board's deliberation with respect to the approval of the fee. That, as you could probably imagine, caused a lot of consternation among securities lawyers and mutual fund lawyers when you're basically filing a public document with the SEC describing the board's process. And over time, and the initial filings, this came into play some years ago, the initial filings were very limited in what they described, and the SEC has continuously pushed on fund issuers during in examinations and in comments to expand that disclosure related to the board's approval. It makes the board members a bit nervous, but it's an interesting little wrinkle in you know, when you consider board oversight of mutual funds.
Yeah. Another important thing to note is that the approval of investment advisory fees is subject to a whole history of judicial jurisprudence on the issue. The Supreme Court of the United States has actually weighed on this issue one time, and there's been many Court of Appeal cases back and forth with regard to the board's determination of what they consider to be a reasonable investment advisory fee, and also the contract itself. So in addition, there are also finally requirements for the safekeeping of assets. The fund assets must be kept with a qualified custodian. That is generally considered to be a bank. As a result of these additional burdens imposed by the 1940 Act, mutual funds generally have greater administrative fees, but these fees can be spread out over a large number of investors and a larger amount of assets than other types of pooled investment vehicles. So now we're going to get into the ETFs, which is, again, a form of 1940 Act fund, and Fabio is going to discuss that.
Okay, thanks, Chris. Just before we get too much into this, I'll point out that over the last few years, you've seen a proliferation of what we'll call exchange-traded products, and those include things like exchange-traded notes, ETFs that are not structured as 1940 Act funds. They may be grantor trusts or other vehicles. So what we're focused on really today are ETFs that are structured as 1940 Act funds and subject to that regulation. So generally, an ETF is a mutual fund in most ways, and the real difference is only related to how its shares are sold and how they trade. But for the most part, it's subject to all of the aspects of regulation that Chris described. The mutual fund issues, or the ETF issues and redeems its shares in large aggregations called creation units. These are typically done in kind, meaning that the transaction is done with a basket of portfolio securities being delivered to the ETF in return for ETF shares. Those transactions are done only with firms called authorized participants. Those are firms that contract with the ETF in order to allow them to engage in these in-kind transactions. Those authorized participants then distribute shares in the secondary market for sale to investors. So unlike a mutual fund where an investor is purchasing and redeeming shares directly with the fund, in the ETF context, it's secondary market trading, and the authorized participants are the only ones that transact directly with the ETF. As I mentioned, the creation unit purchases and redemptions are generally for a basket of securities. This is, again, significantly different than a mutual fund, which typically transacts in cash, and it has some impact on an investor in the fund, and we'll talk about that in a minute. So what are the ETF's advantages over a mutual fund? And as I mentioned before, they've grown quite a bit over the last 10 years or so. One is cost efficiency. This, I think, will change over time. When we say here lower shareholder servicing costs, mutual funds generally pay shareholder servicing costs. ETFs at this point have been priced in a way that kind of avoids that, but I think that will change as they become more and more of a competitor to mutual funds in the marketplace. The in-kind transactions can generally reduce portfolio transaction costs. And so when a mutual fund takes cash in, it has to purchase securities, it pays transaction costs. The ETF, because of the in-kind transaction mechanism, is getting portfolio securities delivered, and they can go straight into the portfolio without imposing transaction costs. So you're essentially externalizing some of the portfolio transaction costs that a mutual fund would typically, mutual fund shareholders would typically bear.
So Fabio, does that mean that then there's another layer of transaction costs from the authorized participants so that a purchaser will end up sort of paying the same amount ultimately?
The authorized participant would bear transaction costs in acquiring the portfolio securities that they then have to deliver to the fund.
And vice versa on redemption?
Absolutely. And so those are costs that the authorized participants bear as part of their.
But that would presumably be passed through to the ultimate purchaser?
Yeah, it would impact the price of the ETF share.
Mm-hmm.
That is, yes.
Okay.
Tax efficiency, as I mentioned, because of these in-kind redemptions, if you have, for example, portfolio securities that have appreciated in value, if you were to sell in a typical mutual fund redemption, the fund manager sells those and delivers cash to the investors, realizing capital gains. In the ETF world, you can, if you're engaging in these in-kind redemptions, you basically are again externalizing the capital gains tax on the appreciated securities. ETF advantages, again, trading flexibility. This is a significant difference between ETFs and mutual funds in that they can be traded intraday and they can be shorted. This makes them more attractive to institutional investors, and we hear from a lot of our hedge fund clients or a lot of our ETF clients that hedge funds are some of the biggest investors in ETFs, depending on the type of ETF.
So just a sec on this externalized capital gains, does that also go to the authorized participant?
Yes.
Okay. So so basically, it seems as though a lot of the functions of mutual funds or in ETFs are split between the ETF sponsor and the authorized participant. But I mean, those costs are still, if you're an investor, you're still going to pay those costs somehow.
Yeah, I think so. But you don't. It's just a different. It's not hitting the NAV of the fund, for example. I guess is the best way to think about it.
Mm-hmm. But it's going to hit you somehow.
It will. Yeah. Lower distribution expenses. This is one, again, that I think will change. Mutual funds, as Chris mentioned, there's a rule under the 1940 Act that permits mutual funds to use their assets to pay for distribution with certain limitations. That's Rule 12b-1. It's pretty familiar to mutual fund investors. And what that says essentially is that mutual fund assets can be used to pay for distribution up to certain basis point levels. To date, I'm not aware of any ETFs that actually charge 12b-1 fees. What normally happens when you set up an ETF initially is you will put a 12b-1 plan in place. And the reason you do that is because Rule 12b-1 says that once the fund's up and running and you want to implement a 12b-1 plan, you would need a vote of shareholders. So what ETFs typically have done is put that plan in place, but not started to charge the fees so that they have it available down the road. And that's typical for most of the 1940 Act ETFs that are out there. As you see more and more pressure from the financial intermediaries, the Schwabs of the world, basically to get paid out of the fund, you might see those 12b-1 fees start to be essentially turned on by the fund's boards, and the pricing, in my view, of the ETFs will start to move more toward mutual fund pricing, because there's the demand to pay the financial intermediaries that are doing a lot of the shareholder servicing is there. Couple things on ETFs, and this is, I think, again, relevant to the SEC's perception of risk. The 1940 Act, interestingly, despite the fact that there are such a large number of ETFs now, the 1940 Act technically doesn't permit the operation of ETFs, and so Congress has never okayed an ETF if you, as a product. It is 100% a creature of the ability granted to the SEC under the 1940 Act to provide for exemptions from that act. And so when the 1940 Act was adopted, it contained several provisions, and still contains several provisions that grant the SEC pretty broad authority to provide exemptions from the provisions of the Act. And so it is in reliance on those SEC exemptions that ETFs operate. A couple examples would be the 1940 Act requires that mutual fund shares trade at a price based on NAV. Well, ETF, as we know, ETF shares trade in the secondary market and may or may not be directly tied to NAV. So there's an exemption that has to be obtained from the SEC in that regard. Various other exemptions. And so the way you do that is, and so I think just to tie that back to risk, I think the SEC, I know from conversations I've had with the officials there, that they are sensitive to the fact that this is a product of their creation, and that they need to be, careful with how broadly they permit it to be, what they allow and what they allow these funds to do. So as I mentioned, the operation would violate the 1940 Act in several ways. So how do you launch an ETF? You have to go to the SEC and get specific exemptive relief. There's two types of exemptive relief. One is for an index-based ETF and one is for an actively managed ETF. You have to apply to the SEC. It's a process that in the past could take up to 18 months. It's been significantly shortened now. If you file an application with the SEC that is well precedented and in line with the existing ETFs that are out there, you can typically get out in 3 or 4 months at this point. And so that's a big change from where it was 4 or 5 years ago. If you're presenting an ETF that presents novel issues for the staff, it's an indefinite period. If it's something that the SEC hasn't seen and that they need to digest, you could be in there for years. And we've seen that with these fully transparent, actively managed. Right now, if you run an actively managed ETF, you have to have full portfolio transparency on a daily basis, and that's kept a lot of the big traditional asset managers out of that space. There are several proposals down at the SEC now, that would allow for non-transparent or limited transparency in the ETF market. So and I think that would be a significant development in that it would allow the traditional asset managers who don't want to show daily portfolio transactions to the public to get into the space. And so some of those proposals include things like having a blind trust where assets would be managed, which would allow the authorized participants essentially to engage in the transactions with the fund, but wouldn't be disclosed to the public. Tracking portfolios, which would be a portfolio that's designed to mimic the market sensitivities of the ETF portfolio without actually disclosing the holdings. So there's several proposals down there now, but that's something I think that you'll see over the course of the next year and a half, maybe 2 years. You'll see some movement from the SEC on that, and that could be a game changer for traditional asset managers jumping into the ETF space where they haven't done so to date.
By traditional asset managers, are you talking about mutual funds, hedge funds, or both?
Traditional asset managers, I mean mutual funds. So I mean
Okay.
the Franklin Templetons and the Fidelities and those committing to the actively managed ETF space in a significant way. To date, you've seen them do sort of just small touches, kind of dipping a toe in the water at this point, but not making significant commitments. And a big part of that is because of the concerns about the full portfolio transparency. So let me just talk a little bit about changes at the SEC. And Nick and I were discussing this sort of offline. So within the Division of Investment Management at the SEC, which is the division that regulates mutual funds, hedge funds, all the products that we're talking about, they've recently created, in October 2012, a group called the Risk and Examinations Office. And this is, I think, consistent with some other changes that we'll describe at the SEC, where they're basically trying to regulate in a somewhat different way. The SEC has historically had an Office of Compliance, Inspections, and Examinations, which is the office that visits asset managers and kicks the tires and requests all sorts of data and does that on a regular basis. This is a bit of a new division. It was mandated in part by Dodd-Frank, and what it does is it basically employs risk analytics and financial analysis to support the efforts of the division. And so the way it's been described to me is that the folks that do this work, this financial analysis and the risk analysis, they touch every part of the SEC. They interact with the enforcement folks, they interact with the rulemaking and policy folks, they interact with the disclosure folks, and so it's meant to be basically a function to support the SEC's various activities. And an example, and then separately, the SEC has a Division of Economic and Risk Analysis, which performs a similar function in a more broad sense in that it's not just limited to the Division of Investment Management. But one of the things, just by way of example, that we've seen out of this, the Enforcement Division within the SEC has instituted a program over the last few years called the Aberrational Performance Inquiry. What that is it's using financial analysis to look at hedge fund performance and identify outliers, and compare that to the disclosed strategies used by the hedge fund, and try to identify a fund that's showing performance that is either consistent in a way that just doesn't make sense from a risk analysis standpoint, or completely out of line with peer funds that are implementing similar strategies. And there's been several enforcement actions over the last 2 or 3 years that the SEC has brought based on the use of that system. And so that's a significant change in how the SEC is operating, and I think kind of in some ways forced by resource constraints. So just last week, the SEC announced the formation of the Office of Risk Assessment within the Division of Economic and Risk Analysis. They're performing a similar function. They are basically, economists, financial analysts, accountants, and it's a sort of departure, again, and what's consistent with this whole departure in the way that the SEC is viewing these products and the way that they're looking at them. And it ties back to what I mentioned before about Form PF. The SEC now having this information is working on ways to use it. Yes.
Yeah. Now, just touching on regulation, the regulation supervision, the 2 areas which I am probably most concerned about with the investment management industry is impact on financial stability as an industry, and the other one, which is really the whole question of fiduciary care for investor protection. And this, when we talk about this, I think this financial stability is probably a big subject on its own. Can talk about just on fiduciary care and investor protection. We kind of think about some of these things like the investment management company structures are primarily geared towards fee collection. They are very AUM based, and there's very little skin in the game. And I think structurally there may be some concerns that no matter what kind of fiduciary care standards or even regulations or investor protection legislation that may be put in, will never be able to outweigh the fact that structurally it's not designed to create the kind of alignment of interest. So my question to you is there something that could be done, or is the investment management company now hunky-dory, it's okay, or do we need to do something about addressing some of these concerns?
Yeah, so I think it's a lot to think about. I guess, so I'll think about it in the mutual fund context, for example. And so the question really is, what are we doing to make sure that the interests of the asset manager are aligned with the investors in the funds, right? And I would say that historically, the response to that is mutual funds have an independent board of directors that are charged under the 1940 Act to look out for the interests of shareholders. And the SEC typically refers to them as watchdogs. What that means really is that they're there to deal with conflicts of interest that can arise between the advisor and the funds. That is the way the structure is set up, and I think my sense is that it's been pretty effective over time, and I don't know of any sort of trends that would currently that would cause the SEC to revisit that structure.
Another important thing to note that is that the case law and the statutes and the rules, they don't prohibit the investment advisor from making a profit. It's basically all the case law and everything has come down to whether or not those fees are excessive, and if they were negotiated at arm's length with the board of directors.
Yeah, just in terms of, if we look at most of the investment management vehicles, most of them are very interested primarily in building up their asset under management, because it drives fees. And many of them are not exactly persuaded by, or rather incentivized by, looking exactly in line with the underlying investors' interest of driving returns on the assets that they're managing. So it would be very different if the investment management company put down 80% of their own money under any AUM.
Yeah.
Well, two and 20 with a high water mark.
I think that kind of framework creates a lot more incentive for them to align their interests.
Yeah, but I think we'll have a couple issues with that. One would be the investment manager is not given their business, they may not want the exposure that the fund is providing for various reasons. I mean, that's been the criticism historically of, proposals to have investment company boards of directors invest in the funds. And one of the responses you hear often from directors is, well, I'm nearing retirement. I don't want to be in this sort of small cap growth product, and it's not appropriate for me to be in that, and tying my interest to the fund in that way is inappropriate. But I think that the structure that's in place where the fees are disclosed and the board is there to sort of modify those conflicts, I think that's the best you're going to do in terms of aligning the interests of the advisor with the investors in the fund. And one thing I would also mention is it's not terribly uncommon for mutual funds to close to new investors because they feel capacity constrained. And so that's an example of the asset manager not acting entirely in its own interest, because obviously if the fund's performing really well and it's taking in a lot of assets, it's getting paid a basis point fee on those assets. If it closes the fund to new investors, it's foregoing fees, but it's doing that because it doesn't feel like it can appropriately manage the portfolio given the flows. And so there is some of that, and that's an example.
I would also just have to add that if you look at the classic hedge fund 2 and 20 fee structure with a high watermark, that gives a huge incentive to for them to be profitable, right? So that 20 kicker on profits with a high watermark, that's where the big upside is for the hedge fund managers.
I would only add though that the investors who are investing in hedge funds want to see that GP, the manager of that fund, have a high portion of big in the game, and a high portion of his own net worth in the fund. So that does limit the risk, and that does align the interests of the LP with the GP much more closely. And the 20, 2 and 20 is kind of like, pre-2008. Fees have gone way down. And the 20 sounds like a big number, but you're not getting any of that unless you've either made me money, which means he's risked his own money at the same time, or he surpasses some hurdle, which a lot of investors want these days as well. So you got to compare apples to apples.
I would also argue on the 2 and 20 argument that what we've seen in a lot of funds is that once they get to a certain size, the 2 is sufficiently attractive. So because the 20 is kind of out on the horizon, we see a lot of funds just focusing on continuing and making reasonably poor decisions for their shareholders to continue to refund fees.
One more point on the performance fees. I mentioned before that performance fees are generally only used in the hedge fund. They can be used in mutual funds, and some mutual funds do use them. The SEC rule for a performance fee in a mutual fund basically requires what's called a fulcrum fee. So unlike the 2 and 20, where the 20 is just gains, the way a performance fee is permitted in a mutual fund, is basically to have a fulcrum point, and then the fee can be adjusted based on the portfolio performance relative to an index, and it can be adjusted upward or down. And so the asset managers that use that fee promote it as an alignment of their interests with the investor, with those of the investor. But that's still, I think, the minority approach for mutual fund fees.
The only other thing I would add real fast is that in the board of approval, when they approve the investment advisory agreements, one of the things they do focus on is the profitability of the investment advisor.
All right, well, we had a chance in panel 1 to thank the Philly Fed and to thank Janney Montgomery Scott. So let's thank the 2 lawyers from Stradley Ronan. Okay, what we'll do is we'll take a 20-minute break, so we will reconvene at 11:15 a.m. as opposed to 11:10 a.m. Okay, thank you.
So go nibble and graze on everything.
Oh, really? Oh, okay.
I don't hear anyone. So-
Okay, that's fine, because usually I put my cell phone in, I check the bin and I say, because I was trying to. All right, thank you. Okay, so we're back in, all right. 15 minutes is enough.
Your panel, Frank?
You're busy over there.
Always on the move.
This has been a great meeting.
One thing I know is there's even tomorrow,
That makes it worse when you repeat it.
I don't want to say that out loud.
I was Barron's meeting.
Oh, I see.
Okay, I'd like to welcome to the start of the third panel, somewhat facetiously, but not so much, titled Making Molehills Out of Mountains of Data. What I'm going to do before introducing the panelists, in order to sort of set the stage a little bit, is give a brief introduction and overview of what are some of the issues and topics behind this topic, in order to set the sort of level stage for our discussion. And so, before I do, I would just like to welcome the panelists, Michael Bolden, Werner Hahn, and Tom Kimner, and we'll introduce you when we get to questions. I'm very glad to have them all participate in this. So I'd like to try and speed through this as quickly as possible so we can get to our discussion. And if we can keep questions until the end so we can get to the end and take questions, we'd appreciate it very much. The topic of financial data aggregation is a big one. It's very important. There are a lot of different things in the news about it. The BCBS 239 risk aggregation studies, OTC reporting on trade repositories. There are works at the Financial Stability Board on aggregation feasibility studies. The purported role of the Office of Financial Research is to gather data from various places in order to provide it to all of the other agencies. There's all kinds of ECB and EU oversight. Solvency II says we need to understand what's behind the things that you're actually insuring. There's CCAR, there's the DFAST. All of these things have to deal with data that's looked at from a aggregate point of view, and yet what does it mean to have that? How accurate is it? How useful is it? And so the concept of how do you get from basic information that's actually on the books to something that is actionable is a very important dotted line to make that connection. So this is fairly obvious. In the financial informational pyramid, you have data that comes up from contracts and low-level accounts, all the way up through business units and entities, through the holding companies into industries and sectors in the entire economy. In theory, risk governance travels the opposite direction in order to provide some degree of governance and control over that process. Now, there's several different types of data. There's market data, there's contractual data. We draw this distinction between the two because market data generally is fairly high frequency. It relates to fairly simple structures of things that are bought and sold in the case of equities and the bond markets. Contractual data has to do lots of times with things that are on the books, could be contracts and mortgages, things that have ongoing payment streams, things that are not just on the ticker tape of what was just traded, but actually represent the 90% of the iceberg that represents the full position and exposure of an institution. So when talking about data aggregation and risk aggregation, you have to also be aware that there are different types of data that's dealt with. And many people focus on market data, but the preponderance of exposure and risk is probably in the total position of what's on the books of an institution. Traditionally, organizations have silos. This is a very simplistic view of silos in which business units have all of their different functions going from bottom to top without sharing anything until they get to the top, and you have to provide that to management and then make your compliance activities. Clearly, this is no way to run an airline, so to speak, if you want to have information about total exposure. In order to think about how do you get something that is actionable and meaningful at the high level, one thing that's important to think about is this usually does not come from just accounting systems that roll up balances by business unit or hierarchies related to balances that are in how many 30-year mortgages do I have. And that's because accounting systems with a balance for a type of product or a group of product do not describe the terms or the contracts of the contracts and parameters, such as the interest rate caps and floors, the things that will actually affect the behavior of those contracts. So if we look at what different structures might be, we have the job of how do I make sense of these different structures? How do I aggregate things of different structure? Well, in the traditional and obvious way to do this is to take these different structures, to map them into some form of data model that is consistent, that can go across the board. Now, this is just a sample data model. It doesn't really, this is not a suggested serving in the sense that this is the data model. It's simply that there is a data model that can break down the fundamental relationships amongst the various products across different business lines, such that the organizational and business relationships are not the most important one. It's really what is in the financial products themselves in terms of their structure. By doing this mapping into some form of consistent data model, you're now in a position to, for the purposes of aggregation, apply a consistent aggregation philosophy to this underlying data which has been standardized. And it's important to do this type of, this is the true wheelhouse of aggregated data, if you will. There are many requirements, for example, with the SDRs and trade repositories to have all of the actual deals that have ever been done in detail on the repositories for regulatory examination. This has only brought to light the fact that all the repositories have slightly different formats. There's not really consistency in this, and it's very difficult to necessarily get a good picture of what's going on if you have to then look at every single trade. Institutions are also loath to necessarily publish all of their business. And so one way to reduce the amount of analysis that's required, make it more possible for institutions to volunteer more granular data, is to come up with some aggregation scheme that will preserve the DNA or skeletal structure, critical mass of what's in the portfolio, without having to reveal the details and without losing that with noise in some type of accounting hierarchy roll-up. I liken this to, say, a 16 megapixel image in a camera, which has very high resolution, more than the eye can see, and which is of great size, to reducing that to something like a 300K JPEG, which if you look at it, the eye says perfectly well, this is a very good picture. But there's been a reduction in the total amount of data involved because all of the mappings of the pixels and cells were preserved in the compression of that data. This is a fundamental concept. And so some engine that can tune and use multiple dimensions of different parameters to aggregate financial data to a level or two roll-up to reduce the number of vectors and yet preserve the DNA of that data is really kind of the core recommendation behind a data aggregation strategy. In such a strategy, you could envision the use of this mapping of contracts into a database, then compressed into vectors, and then as the basis for very extensive analyses of all kinds in an institution. Just plug in your flavor of analytical engine and you can use that data. I want to give one example real quick of why this particular process is a tunable process that has an optimization and that has a better and a worse case application. You can think about taking a portfolio or a pool of mortgages or loans, and how you're going to do a weighted average coupon balancing of those mortgages. Here I've got 4 with interest rates on each one from 4.9 down to 4%. And if I take a weighted average coupon balancing using the balance to weight the coupon of this portfolio, I get a weighted average coupon of 4.46%. Now, this is a fairly broad binning. Now there's an impact to this. Obviously, this portfolio, if you look at this portfolio of 2 million, would behave differently in either a 4 or a 5% interest rate environment. So the 4.6 as a weighted average coupon is actually noisy. So if we were to instead say, well, what would happen? And by the way, the figure in yellow, what's been computed here is kind of an error function of the difference in absolute value between the interest of each of the loans at their par actual coupon rate with the weighted average coupon for the portfolio. And so you see the WAC par interest column shows the difference, plus or minus. And if you take the absolute value of that and add it up, that is kind of like a noise distribution around what each one would have actually had. And that's this particular, there we go. I give up. Oh, I'm a lecturer. Okay, no problem. I'll just look at this. If you look, I have a different screen. If you look at the 8.52%, that's the percentage of this total. Thank you. That's the percentage of this total noise factor to the total interest. So 7,600 is 8.5% of the interest of the portfolio of 89.2. Now, if I were to do that in a 50 basis point bin as opposed to 100, I've got 2 bins where in the first bin I've got 4.9 and 4.8, and the others I've got 4.2 and 4.0. I've got 2 bins at 50 basis points. You can see that the total difference in this noise factor is a lot less. I actually now have 2 weighted average coupons of 4.8 and 4.0. I can use this information for further analysis for behavioral modeling much more accurately than I can with an expansion of that binning process. Now, this is a very key consideration for any aggregation of financial data of contractual terms, as opposed to just rolling up hierarchies in accounting systems, because you have to use some form of weighting to weight the impact, just like you would a stock index on the total aggregation. This can continue to roll up. You can set this dial, you can set the bins, you can actually compute the error factor based upon these differences in weights at the time that the aggregation is done, so you can have characteristics that come out of the process, and there would be an optimum that would say number of vectors to process versus minimum amount of total error. So this is a very important approach that I wanted to at least, it's old school data processing. No rocket science here, but it's not fully appreciated in most aggregation of financial contract data because most aggregation is done on accounting numbers. So if we had this particular compressor, we get something which I call a docking model. The docking model has all the weight and density and critical mass of the portfolio, it's just smaller, and it's standardized. And that particular docking model could be used, for example, by the enterprise analysis of the institution. It could also be used as a standard data model that regulators could use to get from different firms, such that that model could be consolidated in a consistent fashion at the systemic level. This is just a sample saying this is what could happen if such a docking model of aggregation were used by the OFR. I want to very quickly show you how it also could apply to the cases of the swap data repositories and trade repositories where you have the problem of different formats. If you had a docking model and you had trade repositories in different formats, that docking model could be summed in a consistent fashion. So if I had different trade repositories and they have different flavors, well, there are different ways that consumers can get that data, and this is a systemic aggregation issue. I can have everybody go to everybody. Well, that's not very effective, and it introduces all kinds of problems. I can have everybody go to one particular centralized guy, which puts all the onus and all the bottleneck and all the mapping issues on one guy. Or I can potentially have a situation where we introduce something called, let's say, a gateway that knows about the formats of particular repositories. It will go out and get that data from the repositories whose formats it's aware of, and it will then federate, the gateways will federate themselves using a standard type of docking model for this data, And if the consumers now want to get information from the whole system, they contact the gateways, and the gateways cooperate in a federated manner. This is just a suggested architecture for how to solve the problems that are coming out of some of the systemic aggregation of trade repositories at the moment. So having gone through this very quick drive-by of aggregation architectures and as well as some of the details involved in the aggregation, I'd like to go ahead and invite the discussion going amongst our panelists. We're not going to have separate slide presentations, but I wanted to have each person have a chance to comment on things that they thought were appropriate, and we'll have a discussion amongst ourselves. First of all, why don't everybody just introduce yourself briefly for the benefit of our audience.
Sure. I'm Michael Golden from the Federal Reserve here. I guess this is a really interesting topic to me. I started to read more about the world of big data because I thought worlds ago I used big data when I put it on a 3 1/4 inch floppy disk, and then we had to get these zip drives, and now we have USB ports that are USBs that have 16 gigabytes, and I don't, can't even fill those with data. So I think it's an interesting topic, and certainly the agenda you talked about of building this federated depository would be useful. Probably a little ways from that, and I think on my slide here I'll talk a little bit about where it might be limited and where it might be successful, things we know that worked in the past.
Thanks, Michael.
And my name is Werner Hahn. I think I was asked to be a part of this panel as sort of a little bit of a counterweight. My background is not as finance intensive as the rest of the panel and other people here as well. I worked for a time at Corporate Executive Board. It's a research advisory firm which helps individual practices within a corporation manage productivity and efficiency issues as well as risk mitigation issues for that corporation. So what interests me about big data is the differences in what people think big data actually means. In financial services, and I think Jeff pointed out very well that big data is so big, the data is so large that you have to come up with new ways to get past limitations on data collection, on data retrieval, on data analysis. When I'm looking at groups in Fortune 500 companies that do assurance functions like audit or compliance or legal or marketing, for them, big data is suddenly having data at all. And they're trying to figure out what to do with these initial data sets when they're overwhelmed by the amount of information that they suddenly can collect and analyze, and trying to find ways to do so in a meaningful fashion without falling into all of the pitfalls that I think the financial services sector has done a very good job of trying to avoid to some degree with some success. So that's the part that I'll be interested in talking about a little more.
Hi, Tom Kimner. Currently at SAS, been at SAS for a little over 5 years now. Prior to that, I spent a number of years, about 14 years at Fannie Mae. Also spent some time at the regulatory agency called OFEA, which is now FHFA, and a little bit of time at a policy think tank in DC as well. I come at this from an applied technology perspective. So I look at modeling, I look at data, I look at things that were done 20 years ago, because big data isn't necessarily a new problem. Dealing with data management, data governance has been something that has been around for a long time. If you go back a number of years, the data warehouse was the promise of nirvana for everybody, right? So if you just spend $1 billion, you create a data warehouse, all your problems will be solved. I mean, what we find is that the world stays one step ahead of technology often. So what happens is we get complexity in instruments. We get complexity in the interaction between instruments, whether it's at a macro level or a micro level. We see more connectedness globally. We see sovereign debt now in Europe impacting what's happening in the US. We see things that are happening in the US impacting different markets in Latin America. So there's an interconnectedness that's always existed, but it's exacerbated. It's accelerated in terms of the pace, how fast it is. We also have this dimension of static versus dynamic information. There's much more dynamic information that's entering our data analysis today, and whether that's market information or it's asset information, it's equity prices, commodity prices. And as Werner mentioned, we're trying to collect more and more and make sense of it. I think one of the things that we have to do is we have to think about information, what we collect, and we have to think about placing value on the information that we collect. Where can we use it? How can we use it to make sense of what's happening in the underlying portfolios that we have and the underlying industries? So we can look at it from a company by company or firm by firm basis, but we also have to look at it collectively as a larger system. Jeff mentioned OFR. And how they're taking a look at integrating information to look at systemic risk. So these things have to balance each other out. So I come at it from how do you apply technology? What's coming up, what's available today that may not have been around years ago that can help us deal with some of these issues?
So since we're sort of started off on a bit of an architectural technological firm, and you very nicely summarized the past versus the present and the future, Tom, maybe I could just follow up with the first question and say, what are some of the maybe challenges now that we have that were different from the successes that you and I both know from the past, and what are some of the issues relating to things like standards and data models? Are there, will the current data models and ontologies like 5.0 and so forth solve these problems, or is there no one size fits all?
That's a really good question to start it off with. And I think some of that goes to a single word in my mind, and that is standards. So if you look at the propagation of standards or the proposed propagation of standards over time, we've had fits and starts, right? Whether it's MISMO, whether it's other kinds of things in terms of adopting standards, LEIs. And Jeff mentioned in his architecture, which is elegant, right? This concept of what I would call kind of a data broker. He's talking about a docking port. The ability to share, leverage information has to be based on developing standards that people can use and deploy and connect with. That's something that we have not done a great job on in the financial industry over the last 20 years. We've done bits and pieces of it. Many companies have gone off on their own and developed their own internal standards. It still becomes very difficult to develop standards that can be done across an industry or even internationally. And that's something that has to be formed at the base for this to be successful in terms of truly looking at systemic risk and other kinds of risks. It's got to have a standard program. There's got to be governance around this as well. There's got to be a collective input to this. And as we look at things that are happening now with the complexity of assets, moving from, say, loan-based assets, which are fairly static, if you think about a mortgage or something else and trying to predict the PDs, LGDs, other kinds of things related to a mortgage. But then you look at what's happening on the traded side, or you look at some of the derivatives where we were with CMO, CDS, and now some of the other kinds of things. Where we've got multiple entities, SPVs, we've got interconnectedness with collateral counterparties, and you look at how that all interrelates, it makes it much more difficult. So developing a set of standards, I think is incredibly important to be able to share this information and make sense of it on a more global basis.
Thanks, Tom. So that's kind of a across-the-board horizontally view of things that need to be addressed. Obviously, aggregation has to look at the entire set of positions. Maybe what I'd like to do now is to go to a topic that is more near and dear to Michael's heart, and that is a specific type of issues related to simple cases versus not so simple cases for certain types of analysis. And I'll let Michael explain sort of the problem and some of his thoughts on that.
So when we got together and thought about different topics, my idea was to think of something that's been somewhat successful in the investment world. And if you don't know backtesting, I'll tell a little bit about it. But I do have 2 data points that backtesting is quite successful. Almost all high-frequency traders, even what Michael Lewis wrote about with Flash Boys, is based on backtesting. They took some investment idea and they applied it to historical data and they said, would it work? Another example, if you know the name David Booth, now it's the Booth School of Business at the University of Chicago. Even though John D. Rockefeller helped found Chicago, they did not name it after him. But David Booth, who learned backtesting as an MBA student, became wealthy enough to contribute enough to have the business school named after him. So I think that's one area we could believe that backtesting has done something, at least for one person. And if you know what backtesting is you take your investment idea and you take it to the past, where the past is stochastic, has randomness to it, and you try to see would it work. There's issues with it. If you do a lot of data mining, it's not really valid. You don't want to fine tune your trading strategy to always win. I can win if I take, let's only invest in S&P 100 stocks the months the S&P went up in that month. We want to do something that's more valid. But to do this, you really have to think about your strategy. There's a data issue. And not to take too much time, I thought about what Jeff had put up. And if I was a researcher, I might be a little leery about the warehouse and the model you had if some of those sources were in flux and I didn't really have control of them. Most of the databases I've worked with have been large integrated databases where they were fixed in time and they weren't changing on me. So I would think there's something there that you want to have your different sources that you wouldn't be touching to do this type of work. Make sure that they're not changing on you as you're evaluating, and that could be a little bit worrisome.
So-
But I'm sure there are
Well,
controls
so
to that.
I'll let you continue, but just to interject in that briefly, I think that's an important point. Most of the assumptions that I did not mention about the value of this type of analysis is, I would say, you would in fact follow that rule. You want to do an extract that is consistent as of a point in time, a slice of the balance sheet, a slice of the position. You're getting a read-only copy that you can refresh later if you need to. You're not trying to insert some complex event processing on-the-fly aggregation into the plumbing of an institution. You'll never get the permission to jack the house up to reinstall copper pipes, for starters. But you'll also introduce all kinds of issues of consistency. So it is very important to think of this aggregation and risk management function as one that is updated in a timely fashion, but is not trying to play a role in actual, say, high-frequency trading. And so I think that's a very important point.
Right. So I'll just finish with the two thoughts of this is that I believe if people had standards of thinking of backtesting, and I'll finish with something that's not quite backtesting, that we probably would not have had the subprime mortgage crisis, that people had actually applied some historical to the right set of mortgages. We probably wouldn't have some collateralized debt obligation crises as we've had, because people would have hopefully looked at the history and applied the right metrics to judge whether these strategies would have worked. Most cases, the strategies wouldn't have made extra money and people wouldn't have put money into them. But really the problem going forward is many of in Wall Street investment banking, new complex assets are being invented where there is no history to work with. And so you have to find some proxies. And that's where I think you really need modeling. And I think modeling will be the way to solve those issues as opposed to data. And maybe you want to all make sure your models are transparent and such. And just to finish, big data probably won't solve that problem. A time machine would. And I don't have the time machine. So models might be our second best thing. And I think in this world of data, the models will be just as important as the data, because Wall Street will continue to invent new securities that had no historical precedent.
So to follow up on that good point as well, we talked about aggregation of data and the importance of doing that in the right way to get a current picture of what exists, what's on the books as of now. And yet now what you want to do is use that data for some analysis to infer things about future risk. And so, I'll get to you, Nick. One sec. And so the question I wanted to follow up with is that using analytical tools based upon, let's say, a successful snapshot of granular and accurate data that has been backtested, let's say, in a model, it's important to have your assumptions about what are your scenarios going forward, your starting conditions, initial conditions. And do you think there would be, is there also a kind of a hidden void here for having standards on just what are the scenarios that are going to be applied consistently to different analyses?
I guess I thought about too much. Probably just being openness might be enough. That someone would know what assumptions you made, what initial conditions, things like that. Just openness may be enough.
One thing I had heard before that if you're doing a stochastic analysis, it's with a pseudo-random sequence. And lots of times there's stochastic analysis done in a portfolio and somebody else will try to redo that analysis with that same portfolio, but they'll use a different pseudo-random sequence.
Right.
And so one aspect is what yield curve evolutions are you thinking of? What are the different lab setups? What is the pseudo-random sequence of your stochastic model? So I was curious, maybe that might be something that would be of interest in the future.
Sure.
Nick, you had a quick question.
Yeah, I mean, when you said that backtesting would have prevented the subprime crisis, I would not be able to agree with you.
I guess I should phrase it differently. If investors had insisted that they only invested in assets that had been backtested, maybe it wouldn't.
Well, I would argue.
Investors don't think this
I would
way.
argue that the subprime crisis was actually created by overfitting the backtest that they had. I mean, they looked at it, they maybe didn't fully parameterize it. You can give all kinds of stuff. I mean, I was at Fannie at the time running their economic capital model, and the whole conversation was, you know, home prices have never declined nationally, right? You back test, that's true.
But they use the wrong home prices.
Well, but see, then you get into a lot of details
Yeah.
and thinking and all this stuff. But back testing, what I'm saying is, you can overfit your back
Okay.
test
Well,
and set up a crash. So
I should say-
when I was a regulator, we would say, you know, back testing is a starting point. It's the absolute minimum.
Yeah.
And there's other stuff that you must do afterwards.
Yeah, so
Otherwise,
what-
you will set yourself up. You will
So let me just finish.
design a
I would-
security to deal with last week's scenario.
I would just say that the prices used in the subprime mortgages back test were the wrong prices. They didn't pass the smell test. They were not the prices
let's-
of the assets.
let's,
It gets too involved.
let's let Michael's defense of backtesting not try to solve the causes of the financial crisis. There's definitely issues there, which I think we'll talk about further. Maybe we can defer that as a follow-on when we get to the finish of our session, but thanks for that point, Nick. So I just wanted to follow up on that. Now, what I'd like to do is go to another aspect of this, which has to do with some of the things you were talking about.
Right.
And that has to do with the fact that, well, okay, so let's assume that we do have a means and a strategy for standardizing things and getting better aggregation and having a more consistent enterprise view that can be applied for the benefit of the enterprise, as well as something that can be supplied to regulators. And we basically have a better system. There's better analysis. There still is the problem of how do you communicate all of this very correct and accurate, detailed information that has been rolled up and applied analyses to in all kinds of scenarios of all kinds of cash flows projected. And you have this hypercube of all of these results to deal with. And you have all these scenarios and all this technology, all this information in a business intelligence view of looking at the entire institution. How do you communicate and make this information and all the other risk inside how do you integrate all the other risk? How do you present this to, let's say, the senior management of the board in a fashion that lets them effectively do something? I'll mention one concept of data leverage, which I think I want to throw out as a thinking point. We've talked about financial leverage, which says if I have $1, and I can secure $30 worth of an asset or some product, I've got a 30-to-1 financial leverage, which is very high. Think in terms of what data leverage is. If you're going to submit on a quarterly basis a 100-page report or a 50-page report with some graphs and some summary totals and some best case, worst case, middle case estimates to management, that the total amount of information from a Claude Shannon point of view involved in these numbers that are aggregate numbers of themselves, just for readability, is 1/1,000,000th. The data leverage of that to what has actually come from all of the information in this institution is tremendous. There's tremendous amount of data leverage in terms of what is actually presented to senior management versus all of the information that has been derived from. And I think therein lies a bit of a problem where there's noise and perhaps misinterpretation, as well as other risks. So Werner, I will not talk about all your stuff and let you continue.
No, I think you make a very valid point. I'd say it goes even further than that. So not just are you limited when you go talk to the board of directors to maybe a presentation that might be half an hour with questions being thrown at you in the middle of it, or sometimes you just being delayed to the point where you don't actually get much of a chance to speak other than say, red, yellow, green, let's go do this. So not only are you just ignoring a large amount of information, a large amount of data that you've been collecting and you've been working on for a long, long time, you're going to be tempted to say things like, what was it, pseudo random stochastic model?
Random sequence.
Yeah, there we go. It's not going to be something that's going to be very easily understood by most people that you're going to run into in the management class. And let me take a step back here and just say this is not necessarily true for every single industry. This is especially true for non-financial industries. And I'll give you a little bit of history on the way risk officers and risk may have been evolving within non-financial industries. Back in the late 1980s, there was a push and a need to realize that risks from things that were not contract related or credit related were jeopardizing the companies. In the 1990s, the chief risk officer started taking more and more power and more authority over aggregating a lot of information, a lot of data, a lot of different kinds of risk, whether that be operational risk or stability risk or legal risks, compliance risks, and audit risks. And as those things happen, we started collecting more and more information, more and more data, but there are very different kinds of data. You have a lot of the quantitative data that we deal with a lot more often when we try and break things down to just numbers in the financial world. There's a lot of things in marketing, there's a lot of things in strategy that are much more qualitative than that. There are opinions about certain things. There's things that you can't really structure in a way that's gonna, you're not gonna be able to apply a model necessarily to it. And I think that leads to people getting into the difference between what an actual risk is and what the uncertainty underlying that risk is going to be. And those might be distinctions that you're not going to run into necessarily with people understanding, especially when you're talking to someone who's not as familiar with quantitative analysis as you might be. This is especially true when you're talking to chief compliance officers or general counsel, even at major firms. They've specialized in a very particular set of skills, and those skills may not necessarily apply to the things that you're going to be able to understand. So it's always tempting to use information, use data, and the analysis that you've done with this to help you and make decisions for you. I would recommend going against that instinct and making sure that the person that you're talking to at the board level is going to go against that instinct as well by always reminding them how wide the uncertainty is of the data that you've been collecting and the risk that you've been collecting. That's really the starting point and the end point for how you communicate these things with people that may not have the same background as you. It's just simplify as much as possible and caveat as much as possible.
So to follow up briefly on that, Werner, one of the things that was introduced here is the fact that there are other types of risk other than, say, market risks, credit risk, and even operational risk. Operational risk covers a lot of turf. Mm-hmm. But and the difficulty in quantizing or aggregating or assigning values even for risk measures to that is itself a challenge. Do you have any ideas or thoughts about how some of the difficulties in integrating the spectrum of risks can be harmonized with some of the more traditional analytical methods of risk management that come from the financial subset that are more understood? I'm putting you on the spot here.
Yeah, no. What I'll say is that there is a lot of territory for young professionals to move into in these areas. Because there has been so little done with data analysis and because big data in these different areas is relatively new. We've never really had to deal with large numbers of large data sets. The ability to use those analytical skills that you're learning in quant models in your classes is going to be incredibly helpful no matter where in the industry you end up and where you end up applying those skills. You really can come into a place and be sort of the Nate Silver of politics in a lot of these areas because you're dealing with information that's brand new for a large number of people. I would say that the best case for you is to try and find ways to take advantage of the areas where you can have quantitative analysis without really being afraid of the qualitative information you're going to run into it. You really want to try and embrace the fact that there are going to be some areas that you just cannot harmonize. You cannot structure certain things. There is not going to be a standardization of different kinds of data necessarily for the area that you're looking at. Don't be afraid of those specific places. Just try and find ways to incorporate the opinions and the values. And one of the things I see on the rise significantly now is the use of survey information, which is sort of that hybrid model between quantitative and qualitative information. And there's risks that are going to be inherent in using a survey to try and quantify the different aspects of your organization, whether that be the culture that you're dealing with or the belief that a certain strategic decision is going to be beneficial to your company. But that is the beginning steps of quantitizing something that in the past has just been the opinion of 4 or 5 people in the room.
So actually, it's good that you emphasize that the fact that the field is changing and that there is unstructured data and other sources that can be inferred. There are firms that are looking at, say, a Twitter activity or website visits in order to infer sentiment about the public, for example, as far as behavioral anticipation. So I think it's important that in the area of data science, there's machine learning and untrained and trained machine learning for young professionals, which is important for us to underscore that the future is going to be with the next wave. It's probably worth saying that this is a tremendously exciting area, not just some cold calculus textbook, because the entire world of data analysis is really opening up to another set of data that needs to be taken into consideration. And I think that that was a good point about making this something for the future for the young professionals. So I appreciate that. I want to follow up with Tom on a point that actually Michael had made offline. He said, well, you just look at other industries and how successful they have been in dealing with these data issues and governance and quality control and so forth. Pharmaceuticals is one example. The airline industry, in terms of global standards, global procedures, supply chain. These are industries that have outperformed in even more challenging and risky circumstances than necessarily analysis of financial data. So I'd like to ask, in light of Michael's observation about the successes of other industries, I asked Tom, what do you think what might occur? What could the financial industry do as a collaboration of the private sector, the players, the regulators do? What's the prospects for how the financial industry might sort of catch up? And obviously a lot of challenges with that.
Yeah, sure. So I'm not an advocate of more regulation necessarily, but what I would say is if you look at pharmaceuticals, you look at airlines, you look at some of the other industries, they're much more heavily regulated. There's a safety component to it that imposes a level of regulation that potentially the financial services don't have, right? So most people would argue financial services are not life and death, where you've got transportation, you've got airlines and other pharmaceuticals. So there's a different level of reporting. There's a different level of standardization around information that goes in. There's a different set of proof that has to come up. Basically, I'll use the word proof in the case of drugs, approvals, other kinds of things. So how the industries are regulated, I think, plays a role in this. There's always been a push to keep the financial industry deregulated as much as possible, and that ebbs and flows within administrations. I'm not a politician, obviously, but my view of it is, depending how strong regulations are, regulations can impose a level of standards that can impose a level of discipline and reporting and around data that can be different for various industries. One thing I would also pick up on that Werner's mentioning is the sort of this concept of unstructured data and the qualitative angle of data, which is entering financial services more and more. So we see this on the customer side a lot. We see sentiment, especially in terms of customer support, where reputation risk is something that is more and more important to many companies, especially at the board and senior management level. And this is often coming through unstructured data. It's coming through text. It's coming through Twitter feeds. It's coming through other kinds of things. And this is an area I think Werner puts out that it's ripe for exploration, right? This is a great area in terms of for young folks to get involved in, and anybody that's interested in this, because it plays a bigger and bigger role. And one of the things that we're looking at is how do you take some of this unstructured information, and contrary to the idea that you can't quantify it, we're taking a look to see if it can be quantified. Right? Is there a way of taking sentiment and producing some type of quantification, some type of standardization around it, so that you can use that into decision making? So that's something that we're trying to look at. We're developing tools that allow us to do that statistically. We're not there yet, but that's something that I think is going to be coming out over time. So I think the more that we can apply standards, the more that we can apply a rigorous body of knowledge and come together to say this is how we want to solve the issue. And we look at other highly regulated industries as a starting point. I think some of that can be applied to financial services, at least around the discipline of understanding the information, because I think as Jeff and Michael's pointed out, we deal with this aggregation of aggregations. So what we do is we wash out a lot of the important information, and we deal with things where we aggregate at such a high level that we lose the richness of the information a lot of times.
Okay, thanks very much. We've been running a little over 40 minutes. I want to now take time for questions from the audience. I will just rapidly, I will end up with a couple of, there are two ways of looking at information. Here's a way of looking at, say, the Abacus deal that failed. There's ways of looking at network analysis of counterparty exposure. Here you have synthetic CDO reinvestments by banks in each other's portfolios. And is it all a moon launch? Well, no, it's really, technology is not the issue. It really is about collaboration, organizational cooperation, regulatory, private sector. So it really is an organizational issue, not a technology issue. Yes.
Yeah, this is interesting, and I come away with two kind of separate ideas. I think it's brilliant to try to take data and aggregate it, the ability to data mine through the internet and weed out the noise into something that's much more useful. You can get overwhelmed with data, so we're just trying to make sense of it. Absolutely where we should be and brilliant, and there are ways to do it. I think it's fabulous. But then there are the models that are trying to kind of tell us something. Models can be very dangerous if you're back testing it and you just say, okay, the analogous situations are the same. And, I sort of then take the Fed models, since this whole, forum is about risk management. I take the Fed models and I say, well, I'm worried that they're trying to use old models, and is a $17 trillion globalized economy something you can kind of really model and assume it's sort of the same? There are some kind of Taylor rule aspects in there that maybe that's just completely broken. And you can sort of try to model economic benefits, but you can't model the risks and the costs to financial instability, things of market liquidity aspects and the herd mentality and moral hazard and things like that. So I find it interesting, and maybe this is a point if you'd like to comment, that if you take the makeup of the FOMC and you say, all right, who are the hawks and the dissenters and the guys worried about financial instability? It's the guys who understand the markets better. It's the guys with risk management, with real experience in that, and the guys who are kind of, have the same kind of group think mentality, or the economists running the models, assuming everything's going to be fine, and we can kind of just monitor it and be okay.
Let me respond, and then I'll pass it to the panel. The distinction you make between, say, risk analysis and aggregation for purposes of microeconomic or firm management versus the systemic risk is completely true, a very important one. I think the benefit of having good data aggregation at a firm level is that it enables a firm to make better decisions about its particular knowledge, market-aware situations. It's more consistent with its data. And the theory would be that if every firm had some more consistent across-the-board silo-busting data, that the firms could themselves have better behavior about their own risk, the collection would be less risky, and they could contribute data to the regulators in a way that was at least able for regulators to consolidate and look at sort of en masse. But the problem of systemic risk and network counterparty exposures and exposure to the counterparties of those counterparties, that problem is not going to be easily solved by any stretch of the imagination through data aggregation alone. So I think it's one.
Quality, not quantity.
Yes. Would anybody like to
I
respond?
want to bring through the models. I think one of the problems is I know I build models and people can build models, that if you really want a result, you can build a model to get that result.
Right.
And probably the better thing is to know that if any type of analysis is done, it was applied to multiple models and robustness was shown, or the parameters of the models were allowed to be randomized in some way. And usually the problem is not really necessarily the idea of using models, but there was a belief that there was one true model. And if we had been a little bit more open and thought of, there cannot be just one true model of how mortgage-backed securities will evolve. There has to be at least 5 or 6, and let's give each of them equal weight if we don't know. And that's really been the problem, is that people believe they had the model, and they didn't.
That's a very good point. Other questions? Yes.
Well, that's a very good point. The problem was, and I was at I won't give the name, but a very large bank that was at the core of the mortgage crisis in New York.
What letter did it begin with?
Something between B and D.
Yeah.
So, and I'm just on a retail trader and strategist, so I'm off to the side of what was going on. And what appeared to be the problem for me was that an over-reliance on the models. It was, true story, I'm walking past the desk where the quants sit. And I have over here 2 quants saying, this can't be. The model says this is impossible. And they say, all right, the problem is all models are backward looking. All right, the trend on the street has been to almost ignore anecdotal evidence. No. It's like the three meteorologists looking over the radar screen, looking over temperature data, trying to predict if it's raining. Meanwhile, it's storming out the window. And that's what that's what the models never did. They never accounted for, at least the ones that I've seen and I've read about, for zero down mortgages, for no credit standards, so when you back tested it, there was no real true backward looking data to model it against. And then the unkunks, the unknown unknowns. There's always going to be something that pops up that didn't before. As this gentleman said, the economy is evolving. Everything changes. You're fighting the last war. You're building a Maginot Line when the Blitzkrieg's coming, and that's what we tend to do. And the problem is when you start focusing on that, that's where you get into trouble. You have to be able to be nimble and see, all right, what's different this time. It's nice to look at what happened before, but you also look at what's new now. If you put them both together, the model works as a good tool. But as an industry, I think we become too focused on relying on the model as an end-all and be-all.
So I would just say that the intent of this discussion was to focus on how to get good quality data that represents the current state of the world in terms of its facts. How you interpret that with various models and assumptions is the next volume of.
Oh, sorry.
So no. You need the good data to produce actual results. It's garbage in, garbage out. So we really just wanted to focus on what is needed to attack the aggregation problem in order to then support and address the subsequent analytical stage. And with that, I think we're at the time. I can see Marty has arrived just in time. So I would like to pass it over to Ralph.
Okay. All right. I just wanted to let you know, I didn't have a disclaimer for this particular event. All right. I know I can make up one on the fly, but I can tell you that this event is much like an event that I attended in Boston for 3 days at the beginning of this week. And I was asking a woman at lunch on Tuesday in Boston, I said, well, you've come to this event. Do you feel like you have more answers? You have one or two more answers? So her response to me was, Ralph, I realize that once I go back from this conference, I have a lot more to do. Okay? So in that regard, we had a lot of thought-provoking information. I'd like to thank the panelists, all right, if we could please. And if anybody can think of a joke, like, 4 data wonks walk into a bar, maybe you can think of something to kind of lighten up the mood a little bit.
I got
Okay,
one.
so.
I got one. Yeah.
Okay.
Bartender says, "We don't serve your kind here." A neutrino walks into a bar. It was a speed of light joke.
That's good. That's how far above the clouds these people are in cloud computing. Okay, I'm going to let Frank Morsano take the last panel. Okay.
Excellent.
I am.
Take a sip of thing. Fortuitous.
No, I'm going to take that.
Oh, okay.
There's no rocket science here. First, thank you for staying to the end of the event. I appreciate you here for this panel. Today we're going to talk about regulatory trends in managing profitability in financial institutions. Now, we all know that regulation, okay, is impacting financial performance. The Minnesota Fed, or Minneapolis Fed, recently did a study which showed the impact on the ROE and the ROA. And it's a published article that you can actually get online if you like. I actually think I might have sent it to Julian at one point in time. If not, I'll send it to you. All my panelists have actually looked at it. Now, today, each of the panelists are going to be discussing in detail some regulatory aspects. But as we discuss them, I want you to think about certain items that are important here. Okay? One, since we're talking about the future of risk management, we have to think about resources. Okay, yes, we can hire consultants, yes, we can use interim resources, but I think as was alluded to in the last one, we have senior management and the board of directors. Are these individuals skilled enough? Do we have the capabilities in the financial institution at the board level and the executive management level? But also, do we have the skill set in the risk management teams? Second, think about the businesses that are being conducted by financial institutions. As a lot of this regulation goes into place, there are going to be changes to the business units. As we deal with Basel and liquidity risk and all these new changes that are coming down the road, certain businesses may no longer be viable for financial institutions. So there's going to have to be strategic changes. And lastly, restructuring. As we put more and more regulation in, there's going to have to be a rationalization of functions in financial institutions, and maybe the combination of functions, as opposed to keeping all these silos. In the slide we saw earlier, maybe risk and compliance have to come together, or compliance and audit have to come closer together, as opposed to a lot of institutions which have had them separated. Okay, or maybe we have to push some of these functions out into the businesses. And as a lot of people know, we've talked for many years about everyone's a risk manager, but risk management is owned by everybody in an institution. And so that needs to be addressed. So keep into account those three ideas as we go through this. Where we're going to go here is, this is the session topic. We have three fantastic panelists. Annetta, who runs her own consulting firm and has been doing consulting and risk management for a long period of time, and I've known her a very long period of time. Jeff, who's over at Deloitte, and he's been involved with risk for many, many years too. And then finally Marty, okay, and she's been very instrumental in the whole derivative space, which is a very important and changing business model for financial institutions too, and hedge funds and everyone else. And then myself, and yes, Ralph wanted to say I come from the longest distance. I work for a consulting firm in Hong Kong, but I'm also involved with FinRisk, where we're attempting to bring some of these concepts and ideas to Asia and replicate events of this nature. So, please ask questions as we go along. Netta's going to start with profitability and compliance and losing proposition. And you get the...
I get this thing, if I can make this guy work. I've known Frank so long that that's like a 20-year-old photo. I told him to change it, but he went with the old one.
I like the curly hair, so...
Me now. I don't even go there. There's so many things I could say. So Frank said I run my own consulting firm now. What I do is I roam around the world, quite literally. I've worked on about 5 continents in just the past decade, working with banks, other financial institutions, like non-banks, insurers, and funds. So I've worked with all of them, but also the regulators. Sometimes working for regulators, sometimes working with regulators, and sometimes working even against regulators. I've worked with folks domestically, the CFTC, the SEC, the Fed, all the big names. I've worked with a lot of the folks overseas as well, like the FSA, now the PRA in the UK, HKMA, APRA, but even in the Financial Stability Board and the Basel Committee. So I get around. And so for those of us that are long in the tooth, that have been at this for a long time, when we see a lot of the regulatory environment today, what do we see? Well, it's like Back to the Future. Because many of you guys with gray hair in this room can remember the time when we used to complain about regulation being not risk sensitive enough, overly punitive, and so forth. And then we went through a wave of change where we tried to create Basel II and create a more risk-sensitive environment and a more internally models-driven environment, where we use the bank's own models to drive regulation. Now insurers with Solvency II. That was the idea. And what we saw, in fact, was that regulatory capital came down a little bit in the mid-2000s. But we also had a wave of economic crisis, which regulators respond to, and of course it comes up again. This is not a stylized graph. This actually comes from a large financial institution that I work with, and where we actually looked at a portfolio of a representative portfolio, something to mimic their own balance sheets and holdings, and to look at where exactly regulation was taking this institution over time. And the planned regulatory bits, the 2017-2019 stuff, that comes from fundamental review of the trading book, changes that we know will be coming also out of Basel on credit risk and interest rate risk. So we're talking directly to these institutions that have not yet published or even brought into the discussion framework what's going to be happening in 2017 and 2019 and beyond, and projected this on a representative portfolio. So what we're talking about is going from a situation where many years ago we were looking at, on a asset per asset basis, a rise to nearly 4 times the amount of capital holdings, maybe more if we're looking at certain asset groups and mixes, to what we have seen today and in the past.
Annetta,
Yeah.
let's talk about capital optimization.
Yeah.
I mean.
But there is no optimization on the regulatory numbers, really. Not
Sure.
much.
But let's
There's
take it
some,
to a
but not
business,
much.
to a business unit perspective.
Yeah.
And so your capital in 2019 is increasing significantly. That's going to have an impact on your business units.
You got it.
And
I'm
what
gonna
you
get to that in a minute. There's something I call the death spiral. Oh, it's not just, I didn't coin the name really, but I can't really take credit for that, but we'll talk about that in a minute.
Okay.
Okay. Well, while all the capital has been rising precipitously, it's not just capital, right? So we have increases in FTEs, increases in legal expenses, increases in systems requirements, particularly if you're one of those things that we call a SIFI, significantly important financial institution. So, systemic financial institution. So again, back in the good old days, what were they, the bad good old days, we might say, we had risk teams out there working with systems. And frankly, the systems used to be kind of crappy. That's true. It's a reality. No one could ever get investment money for their systems and risk in particular. But the focus of these teams was, in fact, in risk management, understanding and explaining risk, supporting business decisions. And as a consultant, I used to spend a lot of my time, and particularly in those days, working on, well, gee, how can we make business better? What can we do to make better decisions, faster decisions, so on and so forth, and use our risk models. And as we moved into the mid-2000s territory with Basel coming on, we actually thought, oh, this might be all right. Yeah, we understand that we're going to have to make more investment in systems and in governance and so forth, but it's going to come with an alignment of our interests. And so that might be okay, and investment happened, and we had investment in systems and we had investment in FTE. But as that line that I had in the last chart rose up precipitously, what we have seen, particularly like I said, with the SIFI rules and so forth, is that we've got a huge amount of legal burden, governance burden, compliance burden, and systems requirements that align with that have been driving the cost structure enormously. Again, stylized, but real representative bubbles. We have seen a rise in FTE at a roughly 40% over the mid-2000s, basically 1 or 2 additional people per 5 people, not associated with natural growth, associated with pure compliance requirements. So you might grow 10 or 20%, we're talking about 40% above that in every institution. And even in relatively small institutions, because even where they're not compelled to move into these territories, that below 10 billion in the U.S., the regionals in many other parts of the world, regulators continue to up the ante on their requirements. Scenario analysis requirements and so forth just get pushed through. Validation requirements get pushed through to those organizations. So it continues to grow their FTEs. Legal costs, legal teams, legal reserves, and outsourcing of legal counsel 7 times over this period of time. 40% per year, year on year as a minimum across the industry. And systems 10 times. And that's a minimum. at 10. We see some of the larger institutions taking it more beyond that. So what used to be like $1 million or $2 million investment in a system, a model, a system to support a model, is looking more like a $20 million investment. Yeah.
Just a real quick question, is this a ratio increase of a typical firm, or is it an aggregate for the industry?
No, this is a typical firm.
So, okay, so.
But you could probably project it on the industry, yeah.
But the typical firm now is a lot bigger.
Yeah, no, I said it, not also accounting for growth.
Okay.
So this is a growth stabilized ratio increase,
Gotcha, thanks.
okay?
And the typical firm, is it US, North American, or is it global?
It's actually global. These are global statistics. I would imagine that in some jurisdictions like the US where we have, you know, when I rock up to deal with a bank in, let's say, you know, pick any country outside of the United States, almost doesn't matter. I'm dealing with compliance guys and regulatory guys and risk guys and so forth, but almost none of them are legal team. When I rock up to deal with the same group of people on the same issue in the United States, I'm sitting at a table with 3 lawyers. So it's reality.
I work at a globalized Canadian bank, and I gotta tell you, for 3 years running, the fastest growing areas are legal and compliance, and by a long shot, just like the numbers you're saying. I see it firsthand. It's pretty shocking.
Yeah, yeah. I see them in every, you know, I've worked on 5 continents, something like 40 countries, probably 20 of them at least in the past few years. And it's everywhere. It's everywhere. And in countries that are developed as well as lesser developed. It's everywhere. And the problems are slightly different in those locations, but it is what it is, you know? So, back to your point.
Sure.
What are our challenges? Well, the death spiral. What's the death spiral, right? Well, my cost of increase is increased dramatically. My capital has increased dramatically. I'm going to start focusing on the businesses, the clients, the products, the assets, the portfolios that aren't cutting the mustard on a return basis. And if I cut those guys out, well, then I have to spread my fixed costs across a smaller base. And then I cut the next tier out, and I spread those fixed costs against a smaller base again. So eventually, slowly but surely, I wipe out all these little guys, all these little businesses, all these little products, all these customers, and I can't carry my base anymore, and that's the death spiral. We've seen it happen in many industries, in many other ways. We've seen it happen in early days of RAROC analysis, even in banks, where people just messed up the equation and forgot about that it's not just about return, it's about, you know, contribution. And we're seeing it again where many organizations are eyeing up their portfolios and eyeing up those small businesses. Motivating risk professionals. Remember this chart, I've just moved from value add to compliance. And maybe it's some of the same guys. They're not just hired for compliance. These are the model guys, you know, the guys that are analytics related and want to be doing the value add stuff. All of a sudden, now they've just been marginalized into compliance guys, and they want out. Most of even in my clients that are very large that dominate their country positions and can really command the marketplace, they run into difficulty with guys hopping out of risk and wanting to be in the business lines more and more and more because they just can't stand to be compliance bunnies. No offense to those people. That's what you do. It's wonderful. If you're hired for something else, it's not so wonderful. You know, so of course, the bandwidth and resources to just respond to the compliance agenda is a draw in and of itself and a problem. And supporting the business needs, all that value add where the business needed that information has just been refocused entirely on compliance. And there is no relevance to be maintained beyond compliance for many of the risk functions. So unfortunately, what we've seen to date is that everyone's just trying to keep up. It's been a role of regulation after regulation after regulation in most countries ever since about the mid-2000s, and folks are still just keeping up. You know, if it's not one thing, it's another. It's a deepening. It's an enhancement of the agenda over and over and over again into scenario analysis, additional validation, backtesting, all these things that I described before, and we've all been talking about. We are fortunately seeing folks starting to talk about what can we do with all of this. So there are some folks that are starting to lift their heads up and say, what can we do? This is probably the 4th conference I've either been to or seen on the agenda since the beginning of this year where this conversation has been a focus. I'm sorry.
Hi, I'm actually a regulator for community banks, and unfortunately, a lot of the comments that we hear from the community banks is that we're trying to put them out of business, and obviously that's not the case. But do you think that community banks will be able to survive after more regulations and compliance comes out?
I think it's going to be really hard for a community bank if the regulation is simply rolling down to smaller and smaller institutions, the stuff you're asking the big institutions to do. It's especially rampant in the United States. We see it less so overseas. The overseas community will very discreetly focus on those that are the largest institutions and have compelling, regulations that compel those institutions to implement Basel II only at the largest institutions. But we keep drawing the bar lower and lower and lower in the United States. The over 10 billion is a pretty low bar actually for those institutions. And as we take elements of this and drive it down into smaller and smaller institutions, it's pretty tough for these little guys to keep up because the skill sets are way different, really, honestly, than in the really good. And of course the resources in general. That's why it says more consolidation and large-scale specialization, because it's likely possible and actually happening in some of the clients I deal with. Larger institutions eyeing up little institutions again. Folks starting to reconfigure themselves and look at spinning out, again, the large specialist institutions. So it's happening already.
Doesn't it encourage SIFIs just because their economies of scale on?
Yeah, it does kind of encourage SIFIs. And we get back into the too big to fail sort of situation. But around the rest of the world outside of the United States, the concept of SIFI and DSIBs and so forth is still a little more amorphous in a remarkable number of countries. So, I've got clients that are really big, like in the top list of global banking institutions, and they still haven't been identified even as a SIFI in any sense. Oh, not even. Really, 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 really big, and they're a bank, and they still haven't been identified.
Really?
Yes, yes.
With the increased regulation, not only with the larger banks, but community banks, the other participant mentioned, you have a lot of shadow banking increasing, B2B lending increasing.
Yeah.
What are you hearing in terms of excesses in that industry and the response of maybe the Fed, because that business is increasing significantly?
Yeah, it is. It's like anything. As something increases significantly, particularly in certain countries, it'll attract regulation. So, in this country, we've made it possible for it to easily attract regulation. In a lot of countries, it just takes regulatory pressure of varying sorts. A couple of points I want to make before I step off of this podium, though, is that outside of the States, even in these large institutions, remember I said that not everywhere the regulation at the highest levels is compelled. So what does that mean? That means that organizations still have choices, right? They don't have to be IRB compliant in Basel or take the highest levels of Solvency II. And now those that haven't aren't. So what are we seeing? Some of these charts I put up were, the first one is for an organization that is very large and may not ever become advanced model compliant because it doesn't make sense for them. It's easier to stay on standardized. They're not going to do it if they don't get forced to. And there's no regulation in their local environments to force this. Many of the regional institutions, even in big countries, like take Australia, are not advanced model compliant. They don't have to do it. They're not going to do it. Because particularly it looked attractive a bunch of years ago. It doesn't look so attractive now. It's not happening. So it's going to take another wave of regulation in many parts of the world to force those guys into it. or a lot of difficult conversations with their regulators, which is happening in some cases. The last point I do want to make, though, is we are starting to see some interesting, some institutions that have half a breath left in them are starting to still look at what they can do. And those institutions that are doing that are looking at things like, what can we do on both sides of the distribution? Both not only the tail that we tend to focus on, but can we focus on the other side of the distribution? How do we find our pockets of profitability? What happens under different circumstances, so we can be more profitable? Another side of this is how do we use the scenario analysis to do things that can be a little more innovative. Of course, reverse stress testing has been around for a while now, but people are starting to bore into that more carefully, or using this information to try to identify triggers that are specific to their situation, so they don't just speculate on what might be happening in a scenario or crisis scenario, but can actually see the trigger of how that might look in their portfolio and how that flows through their portfolios. So there are some innovations out here. It's not completely dead. It's just really challenging. Yeah.
Jeff?
So I'll hand it back over.
Hello, everybody. If I word this right. So I'm with Deloitte. I've been there a little under a year, and my focus there is on these areas that I'll talk about, but also for kind of a number of large bank clients, but also my focus is on the kind of $8 billion to $80 or $100 billion shops, so kind of that mid-sized sector as well. So I'm very focused there and running several projects there. So some of the main comments are kind of lean toward that sector, if you will. I'd like to talk really about kind of the more significant and far-reaching kind of areas of all the new regulations, not just DFAST, but everything that's been kind of coming out in the last few years. So stress testing, obviously capital planning and enterprise risk management, three cornerstone areas of the kind of the new push, the new regulations, and kind of the governance over all of that. That's where the regulatory environment it's come from, and that's where it's definitely gonna keep going. So my focus will be, just kind of the provisions in each of these areas, clearly with CCAR and DFAST, affects 10 billion and up institutions. We're seeing many below 10 billion. As I mentioned, we kind of go down to the $8 billion level or 5 billion. Some are really kind of gearing up to do this, which is important. It clearly kind of reflects the regulatory focus going forward to push this down. And yeah, there are clear costs of that, which I'll get into. Capital planning, very integrated, very related to stress testing above, but also new kind of focus of stressing. It's not just about kind of dividend capital distribution policy anymore. It's about a lot more revolving around stress testing and strategic issues. And enterprise risk management, enhanced prudential standards, the getting to strong requirements, other things that are being asked of banks. And there's actually a new piece from the OCC, banks ordered to boost risk management to meet OCC expectations. There's a Bloomberg article about it from a couple of weeks ago. That's, it's very much on the forefront. It's not going away. It's very much pedal to the metal from the regulatory standpoint. And obviously, there are costs associated with that. I'd like to talk about those. And these are costs that, these are things that have been around where they've had chief risk officers and enterprise risk management functions, but what they're being asked to ramp those up, integrate them better than they ever have. And so these are costs that are over and above what they experienced in kind of prior years, kind of pre-crisis years. So, just in this is a very generalized diagram, but before you had kind of enterprise risk management, capital planning, stress testing, some elements of stress testing and governance were all kind of separate silos, or separate kind of concepts. So with ERM, there was very little integration. It was kind of a compliance concept and kind of a but mostly just kind of compliance and meeting the regulatory requirement concept. That was separate from capital planning, which is kind of a single path exercise in projecting kind of balance sheets and capital requirements and so on to kind of meet a kind of a static regulatory expectation. Stress testing was really kind of confined mostly to interest rate risk analysis, some liquidity, CRE analysis, some pockets of it around, very little, if any, capital stress testing going on. And then governance was really kind of almost like a SOX concept. It was kind of corporate governance focus. It was less focus on kind of integration and governance over a lot of areas. There are exceptions to that, obviously, but the point is that the substantial ramping up in the expectations there. So now and going forward, obviously, you see this integration of all of these concepts. They're locked together. And where a big regulatory focus is where these are kind of decoupled still elsewhere, where you see kind of decentralized decision making, for example, there's a push to cease that. I mean, to merge these concepts and to move more toward a truly integrated enterprise level focus in these areas. To focus on kind of each one of them a little bit, again, kind of. The key guides, hold on, I'm going to put on my glasses so I can see the screens. So the key guidance for stress testing is, I'm sure you're all aware, is the interagency guidance for banking, for stress testing for banking organizations. That's May of 2012. Sets forth all the principles for stress testing, impacts all stress. It's not just about capital stress testing, which is what we're all familiar with. It really sets an enterprise level expectation for all stress testing activities, and they all need to fit into that kind of framework. And it requires a strong governance framework around stress testing, and so it really heightens that framework, those framework requirements, as well as kind of the obviously heightened analytical capabilities. So impact on costs, obviously very significant, requires new models, new thinking about data. We talked about that earlier, the earlier panel. Lots of, I mean, in the group that I'm working with, where this kind of the smaller range of banks, we're focused on trying to, they simply don't have the data or the bandwidth to go with loan level models. And so we're using a methodology that called a panel bank regression methodology that enables them to use a reasonably robust is probably the wrong word, but a reasonable modeling approach to get started on stress testing. We have a whole separate work stream that's helping them build, both looking back and going forward, data sets that will enable them to migrate to as they grow. And as they expand to move to loan level data models, very costly. Both work streams are very costly. You can't avoid the cost. There are not many corners to cut. Kind of a recurring theme you'll see here. The regulators are very focused here. This is stress testing. Their emphasis on stress testing is acute. It's very strong. They've just been through this raft of exams of the stress testing, the DFAST results for this sector of banks. And I'm also working with larger banks too. It's a very big focus on model validation, compliance types of things, this is just not going to go away. It's going to accelerate. And furthermore, kind of weak models or governance are being and will be exposed and criticized. So there's just not a way to kind of cut the corners here. So in our work we're doing, because this is kind of falling into kind of a cost set right now. We've been doing a lot of comprehensive stress testing projects for banks in this size range I'm talking about. And really the cost has been in the range of about 1.1 or 1.2 million to 1.5 or 1.6 million for that comp. So that's governance, that's stress test models, that's the data work stream that I talked about, that's both PPNR models and aggregation models and credit models, ALLL projection models, lots of modeling dimensions, and the controls around this, the documentation and so on. So for the smaller end of that banks, that's a big amount for all those banks, it's a big amount to bite off. when they didn't have to do it before. So just gives you a sense for cost, and that's a consultant coming in and doing, which I think makes sense because you have a one-time build. You don't have the bandwidth or the people internally to get it done and to get it off the ground. So it makes sense for, you have to do this. It makes sense for a consultant to come in and do it. But then on a going forward basis, they need their own team to do it, to run the models that we leave behind and to manage the governance aspects of this. They have a whole other infrastructure they need to build on the go forward. And that's an ongoing cost. I don't really have kind of numbers on that, if you will, but it's, it's a number of FTE and not junior FTE.
So Jeff, let me ask you, do you think there's an outsourcing capability here for the smaller financial institutions with regard to some of this, as opposed to bringing it in-house?
Yeah, so that's something you have to be really careful with. And I think actually my firm would dissuade doing that because there's a tendency to not embrace the whole function when you outsource. And so, and the regulators don't want to look to the outsource firm. They want to look to management to have really embraced this. I think there's a place, but we want to be real careful.
Okay.
This is something that regulators are very focused on. They want this to be homegrown, not top to bottom, top down. So
If it helps, I've seen in other countries, it actually being heavily restricted in a number of places. So it's attractive for sure, but it's tough.
I know.
You had a question?
As a regulator, we probably would criticize the bank for outsourcing, and this kind of ties into my next question.
You would? I'm sorry, you would?
We would be
Yeah,
criticizing,
yeah.
we obviously want the expertise and
Yes, exactly.
decision.
Yeah.
So that actually goes into my question. Do you think that the current management in those shops that you're doing the consulting for, do they have the expertise to understand what the model is showing?
Yes. Yeah, I'd say yes, they do.
Okay.
They do. If they didn't have it before we started, they have it now. They've really been hiring in, and they kind of get the data issues, and they've got through kind of a push month. They're moving forward with the data issues. They understand kind of the modeling issues. They don't understand the models per se necessarily. They understand the outputs of them and the sensitivity of those outputs. So yeah, I would. That's an encourage. It's not as dire as you would think. I think you go down in the food chain, and yeah, they don't have the people.
I don't want to sway you from the big four, but there are actually a lot of boutique firms in North America that focus on community banks. And there are a lot of gray-haired individuals in that area who've done this work for many, many years and actually still keep their hands dirty. So that might be an option for saving costs, because the big four for a community bank will cost you a lot more money than a boutique.
Yeah, you might be able to get that done for less expensive, but there's a lot of work going on to build a truly comprehensive one that will be regulatory acceptable for sure, which you've seen kind of all kinds there. But very quickly, capital planning. You're probably very familiar with this. The OCC's guidance for evaluating capital planning and adequacy, June of 2012. It's kind of the guidebook for kind of community banks and for in the size range I'm talking about here. Steps up the requirements for the integration of capital planning and risk management, risk categories. The notion of risk appetite statements and capital planning are kind of are interlocked now, whereas before they were separate concepts altogether. For example, costs, there are usually capital planning capabilities already in an institution. They kind of get capital because they've had to for quite some time. But, there's a new governance overlay that's required for capital planning, the integration with stress testing. Consultants are sometimes used for that. It's tough to gear that up internally alone, but there's a cost obviously associated with that. And again, can't avoid the cost. Regulators are very focused here. It's all about, step back and think about, it's all about capital planning and building the sensitivity analysis around capital planning, and that's what the stress testing is. So you're not going to avoid the cost on this one. Although it's less than building an enterprise-wide kind of stress testing.
And Jeff, can we move on to Marty now? I'm sorry.
Yeah, and then a little bit on ERM here on the chart, but sorry, it took a little bit longer. But anyway, thanks.
Thank you. Sorry. You wanna go up or you wanna stay here?
I could do either one. Okay,
You need
yeah,
the clicker though.
Oh,
Oh,
okay.
oh,
Yeah,
yeah.
yeah.
What way do you
Oh,
want
it's,
to
it's
take
hard to do. Well, I'll stand up. It's my easier. I feel badly because we kind of cut you off. And I know you've got a lot to share, but you're going to stick around a little bit. Afterwards, yeah.
Answer
Okay.
questions, always good to get questions too.
Okay. Okay, good. So here we go. This is this.
And the deck is posted online if I recall, based upon.
A lot of gray hair since then. Just by a show of hands, how many of you have a background in either in derivatives or maybe have work at an institution that uses derivatives? So we've got a couple, a few people, and okay, great. That's good. I mean, today's presentation is really quick, just also in the sake of time. I'm going to cover really just some very basic, what I consider extremely disruptive changes that have happened in the capital markets with respect to derivatives. And this really just captures the substance of the regulations. I should tell you a little bit about myself only because I know we've got somebody from Sup and Reg back there. I used to be in banking supervision and regulation for the Federal Reserve System, first in Chicago, and then moving to the Federal Reserve Board of Governors. With responsibility for First District, Boston, and then 12th District, and I've done a lot of other things since then. I've been a banker myself, went back to work for the FHFA right after the Lehman Brothers crisis, and worked with Fannie Mae and Freddie Mac in helping them get to central clearing. And central clearing of their derivative contracts. They are the largest derivatives holders in the world with at the time that I joined them, both Fannie Mae and Freddie Mac had a notional balances of $1 trillion each of derivative contracts. And they were also unwinding about 800 to 900 billion in notional contracts every year. So they're dynamic hedgers, they're putting derivatives on, taking them off, and I directed the program to evaluate the clearinghouses, the futures commission merchants, and also to bring them to begin working with CEFs and negotiating trades in the new landscape as provided by Dodd-Frank. Let's see which button.
Right button.
Right. The right one. Okay, great. I'm sure you're familiar with what happened in Wall Street and sort of the catalyst of the crisis, but I want to direct you to a white paper. It was called the Derivatives Dealers Club. The Derivatives Dealers Club was a paper that was written by Robert Lighton from Brookings Institution. It became the blueprint for what we know today as Title VII of the Dodd-Frank legislation. What's relevant here, and I think it's something that Jeff and the group before us would in the panel about data, is Lighton recognizes that the Dealers Club controlled the data that was associated with derivatives trades. And if you control the data, you control the market. And to the extent that they had such opacity in the market, these guys, I mean, life was so good for so long, and then AIG ruined it because and it's really, AIG killed the goose that laid the golden egg for the derivatives dealers on Wall Street and in other parts of the world as well. The failure of AIG meant and brought to the attention of the regulatory community the fact that this opacity is not good. How can we deal with black swan events where you have so many financial institutions that become insolvent, not because of derivatives. They became insolvent because of their holdings of CDOs, collateralized debt obligations, that got downwritten because of the mortgage crisis. They were supported by subprime mortgages that weren't worth, really the paper that they were printed on. So anyways, and we know what happened with Lehman Brothers. Again, Lehman Brothers failed predominantly because of their CDO investments, but they also had a lot of derivatives, and they were clamoring around. So clearly the focus of government became to arrest this problem and direct attention at resolving systemic risk that can be brought about by a domino effect that takes place in the derivatives market. So thus you had Title VII of Dodd-Frank. And most people think that this is really the biggest part of regulation in terms of the cost to the financial services industry. Why is that? Well, the financial services industry generated at least 30 to 35 billion in profits associated with derivatives. Consequently, any type of regulation that was associated with it, particularly regulation that opens up the market,
permits transparency in pricing was going to be a problem. So these are just some key points. Subjects market participants to registration and oversight. We're talking broker-dealers, we're talking major swap participants. And most of all, and something that's very important to this new regime is that it imposes margin requirements. So now everyone who plays in this space on a larger scale has to post margin, and that has obviously profitability consequences. Swaps, security-based swaps, those are your credit default swaps that are tied to debt instruments and debt indices. Regulated entities now are the obvious players, the broker-dealers, major swap participants as measured by, I think it's 8 billion in notional, so there are institutions out there that are monitoring their notional levels. DCOs, those are central clearinghouses that have responsibility for setting margin requirements, clearing, settling, and reporting requirements. Swap execution facilities are very similar to what you would get if you logged on to Charlie Schwab to buy a stock. You're looking at swaps that are available online that you can trade, buy and sell swaps with the kind of transparency, being able to see bids and offers on a central limit order book. So that is the substance of a swap execution facility. There are about 17 out there, and some are better than others, but they're all coming together, and they're startup companies and trying to address the needs in the marketplace for organizations that will be buying and selling on SEFs. Swap data repositories are the organizations that are collecting the data at the time of the execution of a derivatives trade. Data is sent to the swap data repository. Ones that you would be familiar with are DTCC and CME, but there are about 15 others, and I'm not going to name them right now. The regulators are not just the CFTC and the CFTC, but the SEC. That's a terrible typo. I can't believe I did that. But the bottom line, common sense is the SEC is monitoring the credit default swap single name instruments. So credit default swaps that are tied to a debt issue of a corporation makes sense. It's a security. It's tied to the performance of a security. The CFTC pretty much has everything else, including credit indices. This is important to know because the CFTC, before this, all they did was have responsibility for the regulation of agricultural-based derivatives. So this is a whole new world for them, and it's a tremendous amount of pressure for them as a regulator to get up to speed and cover the financial markets and cover these new entities, these SEFs and the clearing houses and the product area that their staff just does not have a lot of familiarity with. So this is what life looked like before. If you look to the left, prior to Dodd-Frank, where you have broker-dealers engaging in transactions amongst themselves, among their community. And the data that they had used was provided by a company called Market. Well, Market was owned by them, so it was very much a closed society. And what happened with Dodd-Frank, very, very disruptive. All of a sudden, you have this central clearinghouse that, as you can see, all the spokes around the wheel are then they're the futures commission merchants, which are typically tied to broker-dealer operations. But all of the trades now are going into the CCP. And so the central clearinghouse is now the buyer for every seller and the seller for every buyer. Now, what do you think that does in terms of controlling counterparty credit risk? Probably improves things. Why? Because there's a capital waterfall that's associated with these CCPs. There's more capital resources now that's dedicated to this system. And then finally, the federal government, Treasury and the Federal Reserve through the discount window offers access to the CCPs. So ultimately, the federal government is the backstop, and the CCPs are entities that are too big to fail. And that is all about just creating confidence in the marketplace. So you might consider this sort of a bringing together of risk in one place. This is a circumstance in which we have to have confidence in a single purpose entity that's just about clearing and settling swap business. So if you're an end user, I have here a major swap participant and other end users. So if you're a hedger, what you'll do is when you execute or buy a swap, you'll go to a swap execution facility, and that's going to be online, and you'll see where there's bid and ask on a variety of different types of interest rate swaps, commodity swaps, energy swaps, you name it. It's all online now, and you see the bidding of the price that was never made available before. At the time that execution of the trade takes place, there is data that gets sent to the swap data repository, as well as the designated clearing organization is the same as the CCP. It's your clearinghouse, but it's the one that happens to be designated by you at the time of your trade. So that's sort of the order process flow, and I'm almost done. Okay, and finally, this is really a terrific thing. If you're a treasurer of a corporation, you can see this data at the end of every single day. And I just picked up on the end of the day on the 10th of September some of the USD LIBOR swaps, and you get to see where exactly they settle out. So if you're a treasurer, you can know and plan on where you're going to end up in terms of switching out your LIBOR to fixed rate debt, the kind of prices that you'll see. This has never been available before, and I think it's really a tremendous thing that we've done for our economy and to the benefit of our economy that we can now have that. So, to the extent that this program today is about looking at costs and benefits, this is costing the financial services industry quite a lot of money in foregone profits. I mean, they really had a good thing going for a long, long time, and Dodd-Frank completely disrupted it. However, there are a lot of other benefits to it that will ensure the longevity of the financial services industry and our economy in general for organizations that are highly leveraged, in that we have transparent pricing, enhanced competition. I mean, these are sort of the most important elements of a capitalistic society that we've been able to achieve through Dodd-Frank. Greater use of technology, using the margins so there's greater confidence that every trade is backed by capital. We've leveled the playing field. There's no more monopoly in this business. Institutions are now being held accountable, greater transparency and reporting by regulatory authorities they've never had oversight. And there's availability of data now, so that the possibilities then of being able to hedge a variety of different types of exposures is much, much greater. So that's all I have to say. Frank, I welcome your comments.
Now, Ralph, I think how are we on time?
Sure.
Time for
Yeah,
questions,
okay.
or?
I was going to say, I don't know,
Or you
what
wanna
I might
hold
do is,
until
I don't know if
after?
you want to make a closing comment. If not, I want Stephen to come up and make closing remarks for the
That's fine.
conference, if you don't mind.
Let us thank the panel. They'll be here after lunch. There. Stephen, please come on up and talk a little about FINRISC.
The Global Interdependent Center has just been a fantastic host, and it had a little bit of help from Financial Risk Institute as co-sponsor of this event. So I wanted the chair of the Financial Risk Institute, Stephen Lee, to make a few closing comments. Right.
Thank you. I guess I'm preventing you from going to wherever you need to go after this. But I just want to thank all of you for coming and joining us in this very interesting discussion. There are many issues that we can talk about. We just do not have the time to deal with them appropriately. But it's really important that we continue to stay engaged. With that said, I do want to thank a couple of people. I'd like to thank Ben Craig, and his team, Jillian, Amanda, for your wonderful work. I'd like to thank Ralph. I'd like to thank Ralph for coordinating on behalf of FinRisk with the GIC and also some of the colleges around here. I'll talk a little bit about that later on. And also like to thank many of the speakers who came from far and near. And some of those are kind of like on this floor, which is great. But those who came all the way from Hong Kong, Frank, we thank you for coming here. And we also have Jeff Bresswell, who came all the way from the West Coast. And a number of us who
either drove up or took a train or whatever mode of transportation we took to come over here from Washington, D.C., New York, and elsewhere. Thank you all. We really appreciate your sharing your expertise and insights into a very important area. Today the topic is about gearing for the future in risk management. And this is really about looking down the pipe and understanding what is coming down the pipe. And listen, we talk about macro issues, we talk about these implications of many of the big picture things, policy risks, geopolitical developments, things which will shape the underlying foundation of many of the things we are familiar with. And we need to understand as risk professionals, as regulators, how this is going to impact the landscape and how are we going to respond because it's all about gearing for the future. We're not focused on here and now. I think there are many challenges we have here and now, but it's important that we need to understand what is coming down the pipe. So we have that. We also talk about the whole supervision, regulation of investment management vehicles, and so some of these other markets which are difficult to supervise, govern, for sake of financial stability, as well as for investor protection and protection of society at large. And I think these are things which we will have always issues that we need to ponder upon in terms of how we deal with many of these challenges ahead of us. And we really, really appreciate this in the discussion on data. I mean, the data actually provide a lot of some of the ingredients will help us to be successful. And there are many well-tried tools and technology that have been done for many years. And many of them are beginning to surface, becoming more available. But I think it's important for us to really understand not just about those data, but how we use them. And this current panel is really something that is very close to my heart. I think when we look at developments in the industry, whether from a supervision perspective or regulation perspective, banks and financial institutions and others are looking to try and balance their business model. How can they continue to be profitable in light of many of these things that are developing, and regulators as well? How can they enhance the market performance without killing the industry? And I think regulators want to do the right thing, and the markets want to do the right thing. It's very important for us to kind of talk to one another, engage, and understand issues, concerns, what works, what doesn't, and deal with some of those exchanges in a way that will be helpful for us to go along. I'd like to kind of talk a little bit about financial risk. We are basically a group of financial risk. We like this fan club. We have many in the regulatory industries who work for regulators. We have many who are professionals in the industry, and others who we are actually looking to try and welcome a group of people who are seeking to enter into the industry. So FinRisk, the Financial Risk Institute, actually focuses on three areas. One is the folks who are in the industry. We look to try and provide development opportunity, to educate, and to provide a forum for us to share knowledge. But we also realize that there is a big group of people who are pre-industry, if you like. They are kind of like studying to enter into the industry or wondering what is happening in the financial services industry or the regulatory community. And what is out there, and what do they do? And listen, we actually talked to a number of colleges, and some of the students actually, while they pursue a course, they may not really understand what opportunities are available to them. And one of the things we would like to try and do is to be able to mentor, to coach, and more importantly, to integrate them into the industry. And this, we believe integrating a group of aspiring risk and regulatory professionals into the industry is a very important aspect of many of us who are soon going to be exiting from the industry. So I think that is a very important aspect, and we would like to continue to engage with young professionals, students, through this maybe collaboration with the GIC and others to continue to drive some of these incentives for students to engage, for us to basically embrace many of these aspirations and bring them into part of the community that will improve the industry, improve the regulation, some of these things that the regulators are also looking for. The other area, which is what we call the post-industry, for lack of a better term, I think there are many who have graying of hairs and others, but it's important for us to continue to be able to tap on those expertise of people who have been in the industry for many years, and they have lots of experience and lots of things that they can share. They have many lessons they've learned, and we'd like to be able to continue to tap on those things, and we expect that this will be developing some programs around advisory, around consulting, around this mentoring, and all those kind of things that we can tap on this group of people to help us promote this. We started here in the U.S. We have representation in London and Singapore, Asia, and this Frank coming all the way from Hong Kong. We're really, really appreciative of all the efforts people are trying to put into developing a very focused group of people talking about financial risk and regulation. We also do publication. We started with a young professionals publication, and we welcome young professionals to engage. In fact, one of the visions we have is that we will have young professionals up here talking to us, sharing their perspectives, and we are the ones sitting behind understanding these perspectives that might be quite different from what we think and believe, because I think those are also important perspectives that we should embrace. So we have that, and we are looking to try and organize more programs. If you want to kind of find out more, you can go to finrisk.org, or you can join our LinkedIn group. We welcome you to do that. And if you have any questions, feel free to approach any of us here. And can I ask those who are in FinRisk just to stand up so the others can know? Jeff, Werner, Frank, actually it's Mari, and we have several others who are no longer here, and of course Rob, So with that, thank you very much, and thanks for coming. We would like to encourage those who like to network, stay behind for 5-10 minutes, get to know these people, because this is a great opportunity for you to at least introduce yourself to people that you want to talk to.
I just wanted to make one last request, and I can't thank you all enough for staying throughout the program. If you like this show, if you like what you heard, if you want to hear more, if you'd like to see these people again, please, please, please fill out the feedback form and give it to our GIC people on the way out, all right? So